This is your exam prep crash course. Every word that's coming out of my mouth, every item that you see on the screen, everything in the actual handouts is something that could possibly be on the test. See, there's a possible 4,000 test questions. You're going to get 125. You can take this test over and over again and not get the same 125 questions. You're going to have to understand why the answer is the answer, so that regardless of how they ask you that question, you'll be able to figure out the answer. You can't memorize question, answer, because what if they ask you the question a little bit differently? Then you're going to be completely lost. You have to understand why the answer is the answer, so that you'll be able to figure out the answer, the correct answer, when they try to trick you. And they do. They try to trick you when you're taking this test. They ask the same question over and over, several different ways. So what I'm going to do now is I'm going to go off camera and I'm going to ask the other panelists to do the same, so that when we have the actual recording, it will be the slides. For those of you that have not met me, my name is Artricia Woods. This is our exam prep class. I teach all of those myself. If you need to reach me, that's our 800 number. Press extension 1, you'll reach me, Vicki, or Shirley Allen, one of the other instructors. If you need to email me, you can email me at that email address. And I also I just showed you a little bit about our Facebook study group. That's probably how you're going to get the quickest answer. If you need to know anything else about us, you can always visit our website, which is mlotrainingacademy.com. So these are the steps that it takes to get licensed. You need to know them because they're the steps that it takes to get licensed, but you also need to know them because there's going to be exam questions about these steps. So you want to know them for two reasons. Number one, you have to go through them. But number two, there's going to be questions on the exam about getting licensed. And these are the ones that you should not get wrong. The first thing that you have to do is get your NMLS number. Highlight the word unique identifier. We call it our NMLS number, but the correct name for it is unique identifier. You may see it either way on the exam. They may ask you the same question, but one time they called it your NMLS number. Then they'll ask you the same question again, but this time they called it your unique identifier. Just know that it's the same thing. You also need to know that they use this number to identify you with instead of your Social Security number. They're going to ask you that. They use your NMLS number instead of your Social Security number. This number will appear on the following documents. Get ready to write this down wherever you're writing down notes. This number will appear on the following documents. It will appear on the 1003 loan application. It will appear on the promissory note. It will appear on mortgages, and it will appear on trust deeds. I'm going to say all four of those again. They're going to ask you, where will the NMLS number appear? Or where will the unique identifier appear? It will appear on the 1003 loan application. It will appear on promissory notes. It will appear on mortgages. And it will appear on trust deeds. They're going to even ask you, where will it not appear? So make yourself a note. It will not appear on appraisal reports. So that's the first step in the entire process. NMLS stands for Nationwide Mortgage Licensing System. After you get your NMLS number, the next thing that you have to do is you have to complete the 20-hour pre-licensing course. You're here, so I'm assuming that everyone has done that. You have to complete 20 hours, highlight the 20-hour pre-licensing course. Answer what they're asking. If they ask you how many hours of pre-licensing do you have to complete, the answer is going to be 20. But if they ask you how many hours of continuing education you have to complete, the answer is 8. And we'll talk about continuing education in a minute. If they ask you how many hours of pre-licensing do you have to complete, the answer is 20. If they ask you how many hours of continuing education you have to complete, the answer is 8. And we'll talk about continuing education in just a bit. And I'm only answering what's going to be on the exam. See, when you guys take the exam, there's more things that happen in the world than on the exam. If it's not something that's going to be on the exam, then I'm not going to talk about it today. After you complete your 20 hours of pre-licensing, you have to take an exam. The national exam with UST component. UST stands for Uniform State Test. That means you only have to take one exam now, and it covers all states. It didn't used to be that way. It used to be that you had to take a national in Texas, a national in Arizona, a national in Utah, a national in whatever state you were trying to be licensed in. Not anymore. One exam covers all states. Now, some states require additional education, but there's no exam, and there's no state-specific questions on any exam, just generic state questions. You have to take a national exam with UST component. After you complete the exam and pass it, you're going to complete an application. The application is called an MU4. It's the application for each individual that needs to become licensed. It's called an MU4. I need you to know that it's an MU4 because there's an MU1, an MU2, an MU3, and then there's an MU4. They're going to ask you which one does each individual have to complete. It's called an MU4. A part of that application is you're going to have to complete fingerprinting, live scan, whether you've done it before because you're a notary, whether you've done it before because you're a policeman. The NMLS wants their own. And they're going to pull your credit. You're going to pay $19 for them to pull your credit. The credit report scares a lot of people because they think, if I have bad credit or do I have to have a certain credit score? No, that's a formality. They have to have it in their file. They're looking to see if you have any criminal activity on your credit report, like Ponzi schemes, fraud, money laundering. Some states put that on your actual credit report. These are the steps that it takes to get licensed. Step number 1 is to get your NMLS number. They also call it your unique identifier. It will appear on the 1003 loan application. It will appear on promissory notes, mortgages, and trust deeds. It might appear a whole bunch of other places as well. But for the exam, you need to know the following. It will appear on the 1003 loan application, for mortgages, promissory notes, and trust deeds. It will not appear on appraisal reports. You have to complete 20 hours of pre-licensing if they ask you that. And if they ask you continuing education, you have to complete 8 hours. You have to take the exam, the national exam with UST component. The application for each individual is called an MU4. And you have to do fingerprinting, and they're going to pull your credit. That's just a part of their process. We can wonder all we want why they want it, but that's not what we're doing today. We're going over what you need to know for the test. These are the 6 steps that it takes to get licensed. You have to pass the test with a score of 75% or higher. Highlight that. They're going to ask you the passing score on the exam. What do you have to pass with? And a lot of people are putting 70. Do you know why they're putting 70? That's the real estate exam. This is not the real estate exam. Don't get that question wrong. The passing score for the NMLS exam is 75%. If you fail the test, you have to wait 30 days before you can retake it. If you fail the test, how long do you have to wait before you can retake it? 30 days. If you fail the test 3 times, you have to wait 6 months. Next to where it says 6 months, I want you to write 180 days because they ask the same questions in different ways. They may say how many months? 6 months. Or they may say how many days? They may say how many days? 180 days. To keep your license current, you have to do 8 hours of continuing education every year. They're going to ask you that. How many hours of continuing education do you have to do each year? 8. And continuing education must be completed by December 31st. They're going to ask you that. What is the last day that someone can complete continuing education? December 31st. The renewal period to renew your license is November 1st to December 31st. So if you get licensed during the renewal period, then you don't have to pay the renewal fees. You're grandfathered into the next year because everyone's license expires each year on December 31st. What does it mean when I say your license expires? It means that you have to renew your license every single year. What does renewing your license mean? Paying them an annual renewal fee and making sure your continuing education is done. So if you get licensed here in May, your license expires December 31st. You have to renew again. If you get licensed in September, it expires December 31st. You have to renew. If you get licensed in November or December, it's not going to expire because you got your license during the renewal period, so it's grandfathered in. Now, all of you guys have not got your license yet, so you won't have to do continuing education this year, but you will have to renew because everyone's license expires every single year on December 31st. Are there any questions on anything on this page? Each year you have to do 8 hours of continuing education once you're licensed. No one on this actual call right now is licensed because you haven't taken the test yet. You won't do continuing education this year. You will renew, but you won't do continuing education because you probably took your 20-hour class this year. They just want to make sure that you take some type of education every single year. So next year, you will do continuing education, and you have to complete it by December 31st. You have to pass with 75% or higher. If you fail the test, you have to wait 30 days or 1 month before retaking it. If you fail it 3 times, you have to wait 6 months, or I told you to write 180 days. You have to do 8 hours of continuing education every year, and you must complete it no later than December 31st. So the 8 hours continuing education, because they're going to try to trick you. You can do it anytime during the year. You want to do it January, February, September, great. You can do your 8 hours anytime during the year as long as you do it by December 31st. However, you can only renew your license, and renewing means paying money. You can only renew your license between November 1st and December 31st. Renewing means paying an annual renewal fee. In California, it's $330. In Hawaii, it's $850. Each state has their own fees, but you can only give it to them. You can only renew between November 1st and December 31st. Everyone's license expires on December 31st unless you've done your continuing education and unless you've paid the fees. The test is 100% computerized. Anybody try the test already? Not fun, right? The test is 100% computerized. You will know right then and there before you get out of your seat if you passed it. You'll be sitting there at the end like, do I press this button? Do I press this button? Because it's going to either say pass or fail. You need to take your ID in there with you when you go. They're not going to let you test unless you have your ID. And you're going to use their calculator. They don't let you bring in a calculator. You have to use their calculator. The test is 125 questions. 10 of them you're not even scored on. I call them fake questions, kind of like fake news. Fake questions. They're testing them out to see if they're hard enough to be on the exam. But don't worry about that. Just try to get all 125 correct. They give you 3 hours and 10 minutes to take the exam. 3 hours and 10 minutes. If you are properly prepared, it should not take you 3 hours to take this test. But what happens is people finish it in an hour and a half, or they finish it in 2 hours, and they see they have time left. And then they go over the test again and change stuff. And again, and they totally mix themselves up. Do not do that. And for those of you that are going back to take the test, that's probably one of the reasons why you didn't pass, because you kept changing things. This is what you want to do. You only want to go through this exam twice. You only want to go through it twice. The first time that you go through it, only answer the questions you 100% know. There's a button that says skip this question or come back to it later. As you go through it, the ones that you know, like the back of your hand, answer. The ones that are math or have a lot to read or you don't know for sure, skip it the first time. But go through the whole test and keep track. I knew at the end there were 63 that I knew like the back of my hand. Then you sit back in your chair. Then you hit the button that says return to skip questions. Then you take a deep breath. Then you pray on the question. Then you rub the screen like you're at a casino. That's when you look at the question up and down, left and right. But once you make a choice, move on. Because at this point, you either know it. Somebody said pray, yes. But at this point, you either know it or you don't. Going back through the test over and over and over again, that is not going to help you. This is my section. I go through this on both classes. Things to remember. There's over 4,000 possible questions. You can take this test over and over again and not get the same questions. I think the only person I know, I had one person that by the time they found me, they had already taken this test 9 times. He had tried everything except for me. You don't want that to be you. That's expensive, it's time consuming, and it's exhausting. You have to not only understand the answer to these questions, you also have to understand how they ask them to try to trick you. In this one line that I'm going to explain to you, they asked this question 30 different ways. I'm going to tell you what to highlight. If an application for credit, could be credit for a house, car, boat, Discover card, motorcycle, doesn't matter. If an application for credit is denied based on the appraisal, I'm not just saying if it's denied. I'm saying if it's denied based on the appraisal. ECOA is the law that says the borrower has 90 days to request a copy of the appraisal. And when they do, the lender has 30 days to deliver it. Highlight ECOA 90 and 30. If an application for credit is denied based on the appraisal, ECOA says the borrower has 90 days to request a copy of the appraisal. And when they do, the lender has 30 days to deliver it. This is how they come up with 30 questions for this particular line. First, I want you to write down 4 words that mean the same thing. Actually, 3. They may say what rule, or they may say what law, or they may say what regulation. That all means the same on the test. Rule, law, regulation. What rule says this? What law says this? What regulation says this? On the exam, they use those words interchangeably. So this is how they come up with 30 questions from this one particular sentence. So I'm going to say the sentence again, and then I'm going to tell you. If an application for credit is denied based on the appraisal, ECOA is the law that says the borrower has 90 days to request a copy of the appraisal, and when they do, the lender has 30 days to deliver it. So this is how they ask this question. What law says the borrower has 90 days to request a copy of the appraisal? Well, there's 3 possible answers. It could be, when they're putting the ABCD, the Equal Credit Opportunities Act, if they're spelling them out. Or it could be ECOA, if they're using acronyms. Or it could be Regulation B, if they're using letters. 3 different ways that they can write that question. What rule says the borrower has 90 days to request a copy? The Equal Credit Opportunities Act, ECOA, or Regulation B? What law says the lender has 30 days to deliver it? Equal Credit Opportunities Act, or ECOA, or Regulation B? Those are the different ways they can ask that question. How many days does the borrower have to request a copy of the appraisal? If they're going by days, it's 90. But what if they put it in months? 3. How many days does the lender have to provide it? If they're putting it in days, 30. But if they're putting it in months, 1. That's 10 ways to ask a question about this one line. Do you guys get that? 10 ways. Circle the word appraisal. And next to it, I want you to write value. By changing that one word, if an application for credit is denied based on the value, my 10 questions just went to 20. Because they're going to ask all the same questions, but they're not going to use the word appraisal. They're going to use the word value. So my 10 questions just went to 20. That's what makes this test so hard. Every single question, there's about 3 ways to answer it. Now, another way that they ask this one that's not so obvious, I'm going to say it first, and then I'm going to have you write it down. What law, what rule, what regulation allows the borrower to challenge the value? Those are my buzzwords there. Challenge the value in the appraisal. When you hear the words challenge the value, I want you to think ECOA, the Equal Credit Opportunities Act, Regulation B. So then my 20 questions go to 30. What law allows you to challenge the value? How many days do they have to challenge the value? When they challenge it, how many days does the lender have to provide it? Now my 20 questions just went to 30. But it doesn't matter how they ask the question if you understand the rule. And the rule says if an application for credit is denied based on the appraisal, ECOA, the Equal Credit Opportunities Act, Regulation B says the borrower has 90 days to request a copy of the appraisal. And when they do, the lender has 30 days to deliver it. It allows the borrower to challenge the value. Because if you get denied and they say it's because of your value, the first thing you're going to want is, let me see that appraisal. Buzzword, challenge the value. That would be ECOA. See, you have to understand why the answer is the answer, so that regardless of how they ask you that question, you'll be able to figure it out. You don't need to know just the answer. What if they change one word? You need to know why the answer is the answer, so that regardless of how they ask you that question, you will be able to figure it out. Now, the next one, on your list of acronyms, I want you to actually find ECOA on there and highlight it. I want to talk a little bit about ECOA. Find ECOA on the list of acronyms. I call that your cheat sheet. Find ECOA on there and highlight it. I need you to know that ECOA stands for the Equal Credit Opportunities Act. ECOA stands for the Equal Credit Opportunities Act. And ECOA is regulation B as in boy. And ECOA is about a credit application. They're going to ask you what law deals with a credit application. ECOA. Regulation B, the Equal Credit Opportunities Act. You're going to learn a lot of letters. Regulation B, D, N, a bunch of them. You're going to need to remember that ECOA is regulation B. This is how I help you remember that ECOA is regulation B. ECOA is the law that says that they must be equal when extending credit. ECOA is regulation B. It says that the regulators, the creditors, must what? Be equal. Write that down. That can help you remember that ECOA is regulation B. It's the law that says that they must be equal when extending credit. What do I mean when I say be equal? They can't discriminate. They cannot look at a credit application and do one thing for a female and a different thing for a male. One thing for African American and a different thing for an Asian. No. ECOA is regulation B, and they must be equal when extending credit. The next one that I want you to highlight is HMDA. HMDA is the Home Mortgage Disclosure Act. And HMDA is regulation C. I need you to know how to remember that HMDA is regulation C. It allows regulators to see where possible discrimination takes place. See, some of the laws, if you know what they're all about, you'll be able to figure out their letter. HMDA is regulation C. It allows regulators to see where possible discrimination takes place. That's a hint for you. HMDA is regulation C. It allows regulators to see where possible discrimination takes place. Then the next question that they're going to ask you is, where is HMDA information found? HMDA information is found on Section 10. It's written like a Roman letter X of the 1003 loan application. Where is HMDA information found? Section 10 of the 1003 loan application. Have you ever looked at the back of a loan application and there's a section that says male, female, Hispanic, non-Hispanic, and you have to tell your race? That's the HMDA section. That's the regulation C section. That's where they keep track, your race, ethnicity, and sex. HMDA is regulation C. It allows regulators to see where possible discrimination takes place. So ECOA is regulation B. The regulators must be equal. HMDA is regulation C. It allows regulators to see where possible discrimination takes place. Where do they see it? Section 10 of the 1003 loan application. RESPA is Regulation X. Highlight that on the list of acronyms. The Real Estate Settlement Procedures Act. The only thing that I need you to know right now is that RESPA is Regulation X. I actually mispronounce it or miswrite it. I write it as REXPA. We're going to get in more detail about it right now, but there's just some things that I want you to know right now. ECOA is Regulation B. You have to be equal. HMDA is Regulation C. Allows regulators to see where possible discrimination takes place. Where do they see it? Section 10 of the 1003. And RESPA is the Real Estate Settlement Procedures Act, and it's Regulation X. So let's call it REXPA to remember that it's Regulation X. The next one is TILA. Find it on your cheat sheet and highlight it. The Truth in Lending Act. It's one of the biggest ones we're going to go over, TILA. So I call it TILA the Godzilla to remember that it's Regulation Z. Now, in your notes, I want you to write that TILA deals with the following. In your notes, I need you to write that TILA deals with the following: credit, APR, and advertising of loans. TILA deals with credit, APR, and advertising of loans. There's a question that says, what law deals with credit, APR, and advertising of loans? TILA, Regulation Z. Or they may say, what law deals with credit? What law deals with advertising? They may break it up. TILA the Godzilla. TILA is Regulation Z. Now this next one is HIPAA. Find it on your cheat sheet, highlight it, and get ready for a lot of notes. The Homeowners Protection Act. The biggest thing I need you to remember about HIPAA is that it deals with PMI, private mortgage insurance. I am not saying MIP. HIPAA deals with PMI, private mortgage insurance, and HIPAA stands for the Homeowners Protection Act. There's 4 things I need you to know. 4 things. Number 1, HIPAA deals with PMI, not MIP. We'll talk about MIP when we get over to FHA loans. But HIPAA deals with PMI, not MIP. Number 2, PMI is on conventional loans, not government. Number 3, PMI is required when the borrower puts less than 20% down. They're going to ask you, when is PMI required? PMI is required when the borrower puts less than a 20% down payment. They may have to pay something called PMI. And number 4, PMI protects the lender. PMI covers the lender. So I'm going to say all 4 of those again. HIPAA deals with PMI, not MIP. That's number 1. Number 2, PMI is on conventional loans, not government. Government loans are FHA, VA, USDA, and we'll talk about those. Number 3, PMI is required when the borrower puts less than 20% down. And number 4, PMI protects the lender. The next one that I want you to find on your cheat sheet is the SAFE Act. The SAFE Act. And when you find it, I want you to circle the word here, secure. Because they're going to ask you, what does the SAFE Act stand for? And they're going to have their A, B, C, D. And A is going to say the Safe and Fair Enforcement Act. And people pick it. The SAFE Act, yes, it's called the SAFE Act, but it stands for the Secure and Fair Enforcement Act. Don't get that wrong. If you're going to get something wrong, get something good wrong, like that, not this. Yes, it's called the SAFE Act, but what does the S stand for? It stands for secure. What does the N stand for in NMLS? So we're about half and half right and half wrong. It does not stand for national. People think it stands for national because you're taking a national test. No, it stands for nationwide. Don't get that wrong on the test. The N in NMLS stands for nationwide. So just remember the jingle. Nationwide is on your side. The N in NMLS stands for nationwide. Yes, you're taking a national test, but that's not what the N in NMLS stands for. It stands for nationwide. Don't get that wrong on the test. The SAFE Act stands for the Secure and Fair Enforcement Act. And then highlight HERA. HERA, Housing and Economic Recovery Act. And in your notes, what I need you to know about HERA is that HERA is the law that created the SAFE Act. When you get a question that says, what law created the SAFE Act? HERA. HERA is the law that created the SAFE Act. FACRA. Find it on your cheat sheet and highlight it. FACRA. Fair Credit Reporting Act. And it's regulation V as in Victor. It's all about, for your notes, a credit report. FACRA is all about a credit report. It's regulation V. Don't you want to have a very good credit report? FACRA, Fair Credit Reporting Act. Listen to me because they're going to try to confuse you. ECOA is regulation B, and it's about a credit application. ECOA is regulation B as in boy, and it's about a credit application, someone applying for credit. FACRA is regulation V as in Victor, and it's about a credit report. FACRA is regulation V as in Victor, and it's about a credit report. They're going to try to confuse you between B and V. ECOA is regulation B, and it's about a credit application. FACRA is regulation V, and it's about a credit report. The next one is FACT Act. FACT Act, Fair and Accurate Credit Transaction Act. The only thing I want you to write right now about FACT Act, until we get into it later, is that the FACT Act is all about identity theft. When they ask you what law, what rule, what regulation deals with identity theft, your answer is going to be the FACT Act. AFBA or ABA, Affiliate Business Arrangement. Notice that I put there 1%, not 10%. Well, why did I do that? Well, because people are picking 10% as the answer on the exam when the answer is actually 1%. 1%. Let me explain this to you. An affiliate business arrangement is a disclosure, a notice that you have to give your client if you're referring them to a business that you also have part ownership in. For example, you're doing a loan for me, and I tell you I can use a roofing company, and you hand me the card of a roofing company and tell me to use that company. If you own a part of that company that you're trying to get me to use, you should disclose that to me, because now you're going to be making money off of me in more than one way. The question on the exam says, if you own more than what percent must you then disclose it? And people are putting 10 because they think 1 is too low. But 1 is the answer, 1%. And then they're going to say, when must that disclosure be made? There's 2 possible answers. The best answer is immediately. But if they have A, B, C, D, and immediately is not one of the options, your next best answer is prior to doc signing. If both immediately and prior to doc signing are options in the A, B, C, D, which one are you going to pick? Immediately. Now, let me tell you 4 words that mean the same on the exam. And you're supposed to know this. 4 words, whether they mean the same to you in the real world. Again, you guys are going to have to separate real world from NMLS world. 4 words that mean the same thing on the exam, or 4 terms. They may say doc signing. Well, that equals the same as loan consummation on the exam, which equals the same as loan settlement on the exam, which equals the same thing as loan closing. On the exam, those terms are used interchangeably. They may say at doc signing, or they may say at loan consummation, and then you get the same question and it'll be at loan settlement, or you get the same question and it'll be at loan closing. And that one loan closing confuses people, especially those that are here in California, because closing to us has a different meaning. But on the exam, it means doc signing, loan consummation, loan settlement. They all mean the same thing as loan closing. Civil Rights Act. Any question you get, I don't care what it is, what year they put to it, if they have the word civil rights in it, the answer is about race. The Civil Rights Act was all about race. Now they ask you 2 questions and they try to confuse you. So I'm going to ask you these 2 questions and you guys are going to put your answer in the chat. Which of the following can you not discriminate against? Age, race, religion, all of the above. Which of the following can you not discriminate against? Age, race, religion, all of the above. Great. That's going to be around number 8 or 9, somewhere early. And then later, you're going to get a question that's going to say, which of the following, according to the Civil Rights Act, can you not discriminate against? Which of the following, according to the Civil Rights Act, can you not discriminate against? You have to understand that that's a different question. This time it asks about that specific law. So make sure you watch out for that, because they're trying to trick you. And most people just see which of the following and they go straight to all of the above. They didn't even read the sentence. You have to read every single word, because they are trying to trick you. And if you get tricked enough, you're going to fail. And you're going to have to pay another $110. You don't want that to be you. You also need to know that an escrow account is the same as an impound account, which is the same as a reserve account. It's the account that the lender sets up to hold the money for your taxes and insurance. Some states say we're going to escrow your taxes and insurance. Some say we're going to impound. Others say they're going to create a reserve account for your taxes and insurance. You need to know that's the same thing. I had one lady said she answered each of them separately with a different way because she wanted to make sure she at least got one right. So she put one answer for escrow, a different answer for impound, a different answer for reserve, so that she can make sure that she got at least one right. No, you're going to be able to do loans in multiple states. Some states call it an escrow account. Some call it an impound account. Some call it a reserve account. You need to know that. This was our warm-up. We haven't even started test prep yet. This was the warm-up. Federal law review. Federal law review. And again, remember, if it's not something that's going to be on the exam, I'm not going to talk about it right now. Not trying to be rude or cut anyone off, but this is exam prep. Exam prep. And if you can't pass the exam, you're not going to be able to do this business. I'm only going to talk about what's going to be on the exam. Save all those other questions and I'll answer them a bit later. But I don't want, when you guys are watching this video, anything that doesn't have to do with the exam, I don't want it on the video. In federal law, you need to make sure you understand what CFPB stands for. CFPB, Consumer Financial Protection Bureau. You need to know what the acronym CFPB stands for. And you need to know what two entities, what two laws, what two regulations created the CFPB. The Dodd-Frank Act and the Consumer Finance Protection Act combined, and they created what we know as the CFPB. The CFPB, I call them the new sheriff in town. They are the rule-making authority for all of these entities here. You just need to know if it has to do with money or banking, they're under the CFPB. If it has to do with money or banking, they have to answer to the CFPB. See, HUD used to be their own boss. Not anymore. They have to answer to the CFPB. So does the FDIC, the FTC, all of these. They now have to answer to the CFPB. Why? Because when the whole mortgage meltdown happened, they went to each of these entities to try to get information. What do you think happened? They all pointed fingers at one another. They all got taken over. And then they all have to answer to the CFPB. A couple of ones that they put in there that they try to trick you with that do not answer to the CFPB. They may say the Fair Housing Act. No, that's about discrimination. And the Department of Commerce. Those are two that they try to throw in and trick you with. Those, the Fair Housing Act answers to HUD. They don't answer to the CFPB. And the Department of Commerce, they just throw that in there to try to throw you off. So I want to talk about RESPA. RESPA is the Real Estate Settlement Procedures Act. RESPA, Real Estate Settlement Procedures Act. The purpose of RESPA is to help consumers become better shoppers for settlement services. To become better shoppers for settlement services. Highlight the word settlement services. Whenever you see settlement services, I want your mind to automatically think RESPA. RESPA deals with 1 to 4 unit residential property. RESPA deals with 1 to 4 unit residential property. Another name for residential property is 1 to 4 unit. 1 to 4 unit property, meaning the owner has to stay in one. It's okay if it's a 3 unit, as long as the owner stays in one. It's okay if it's a 4-plex, as long as the owner stays in one. RESPA rules and regulations and everything else to do with this class and this license has to do with 1 to 4 unit residential property. Now, RESPA does not deal with all cash sales. Even if it's 1 to 4 unit, if they pay all cash for it, RESPA rules and regulations does not apply. It does not apply to rental property of more than 4. It does not apply to commercial property or agricultural property. So make sure you know what agricultural property is. Agricultural property is property that sits on 25 or more acres of land. That's considered agricultural. So what type of property is covered by RESPA? 1 to 4 unit residential property, owner occupied. What type is not? If they paid all cash for it. If it's rental property of more than 4. If it's commercial property. If it sits on 25 or more acres. So I'm going to give you a couple of scenarios and you guys type in the chat box. Is this one covered or not covered by RESPA? It's a 3-unit apartment building and the owner stays in unit B. Yes or no? Yes. Owner occupied. It's a 10-unit apartment building and the owner stays in unit 1. No, because it's more than 4. It's a duplex. I rent both sides out. No, because then it's not owner occupied. It's a single family home, 1 home. I got such a good deal on it. I paid all cash. Yes or no? No. I found a good piece of land and it has a duplex on it and it sits on about 30 acres of land. No. Last one. It's a duplex. I stay in one side and I use the other side for my barbershop. No, because I have a business in one side that makes it commercial. And that's the one that gets people. I live in one side and I use the other side for a barbershop. Well, there's a business in it, so it's not covered. That's considered commercial. The penalty for violating RESPA, $10,000 and or. The penalty for violating RESPA, $10,000 and or up to 1 year in jail. So can the penalty be $5,000 and 6 months in jail? Yes. Can the penalty be $12,000 and 1 year in jail? No. Can the penalty be no jail time and $500? Yes. It just depends on how that judge felt that morning. But the penalty cannot be no more than $10,000 and no more than 1 year in jail, but it can be any combination thereof. Do you guys get that? The penalty for violating RESPA is $10,000 and or up to 1 year in jail. Now, there are several sections of RESPA, and some of you guys didn't take your 20-hour class with me, so you may have learned about a whole bunch of other sections of RESPA. But for the exam, there's only 4 sections that we care about. So I'm only going to talk about those 4 sections. We care about sections 6, 8, 9, and 10. We care about sections 6, 8, 9, and 10. Starting with section 6. Section 6 deals with the mortgage servicer and mortgage servicing abuses. Remember what a servicer is. The servicer may not be the actual investor or owner of the loan, but they're the company that's servicing the loan. What do we mean servicing? They're handling the payments, taxes and insurance, things of that nature. They're handling late payments. They're the servicing company. Well, they did a whole lot of things wrong 8/2009. They wouldn't give people loan mods that qualified. They would hold up short sales. They were taking people's money for taxes and insurance and not paying their taxes and insurance. The mortgage servicer did a whole bunch of things wrong. So what law deals with mortgage servicing and mortgage servicing abuses? RESPA section 6. Now, RESPA Section 8 deals with kickbacks, fee splitting, and unearned fees. RESPA Section 8 prohibits kickbacks, which is another word for referral fees, fee splitting, splitting your money with an unlicensed person, and unearned fees, taking money up front. So let's talk about kickbacks. There's some things you may be able to do in real estate that you cannot do in mortgages. You cannot get referral fees. You cannot take kickbacks. You cannot give me anything of value in exchange for referral of settlement services. You can't give me money to give you referrals. You can't give me Dodger tickets to give you referrals. You can't give me a Gucci purse in exchange for referral. You cannot give me anything in exchange for referrals of mortgage business. That's called a kickback. Fee splitting, splitting your fee with an unlicensed person. In order to get paid in mortgages, you have to have a mortgage license, an NMLS endorsement. You cannot split your fee with an unlicensed person. Sometimes people refer business to you, and when it closes, they want their cut. You can't do that. You can't do that. And most of the time it's family. You can't get mortgage income unless you have a mortgage license. Now, if both of us had an NMLS number, we put both our NMLS numbers on the application, and escrow give you your money, and escrow give me my money. But you cannot split your fee with an unlicensed person. That is a violation of RESPA Section 8. Fee splitting is simply splitting your fee with an unlicensed person, splitting your income with an unlicensed person. Just because someone referred someone to you doesn't mean you're supposed to split your commission with them. Thank you very much. If I have someone that does that needs what you have, I'll refer them to you. And unearned fees, I want you to write it down. Two other words for unearned fees: upfront fees and advance fees. Upfront fees and advance fees. You cannot get paid money upfront before you do anything. You cannot tell your client, okay, so I'm going to charge you 2 points, but I need $500 to get started. No. How do you get paid in real estate and mortgages? When and if the deal closes. You cannot take any money up front. RESPA Section 8 prohibits kickbacks, fee splitting, and unearned fees. Now, RESPA Section 9, and I'm going to tell you guys this now. I didn't make the law. I'm just telling you what it is. And maybe it was different before, but this is what it is now. RESPA Section 9 deals with title. Under RESPA, it is illegal for a property seller to require a home buyer to use a particular title company as a condition of the sale. You cannot make them use a certain title company, and they will argue you down. You cannot make them use a certain title company as a condition of the sale. If you do, and they do it under duress, they can come back and sue for 3 times the amount paid for title insurance. I'm going to give you an example. I had a broker. We looked at all the paperwork for my client, and I said, she agrees to all of this, but she does not want to use this particular title company. And his response was, well, what do you mean? You guys have already agreed the seller chooses all services. Yes, that is a rule, but it does not apply to title insurance. Most people don't know. You can't make them use a particular title company. He didn't know that. He was old school. So he argued, well, it does. You guys are in violation. You guys have already signed that seller can choose all services. And I said, yes, but that does not apply to title insurance. Do you have another title company? Or we can find one Well, what's wrong with our title company? You guys are in violation. If you don't use this title company, we're not going to sell you this house because you're in violation. And I even tried to explain to him, you're getting very close to violating Section 9 of RESPA. And he said, well, I don't know what the hell that is, but let me tell you this. You guys signed saying seller can choose all services, and now you're reneging. I could have gone until I was blue in the face, letting him know that that does not apply to title. So I went back to my borrower and I told my borrower, he's old school, he doesn't get it. He's saying if we don't use this title company, he doesn't want to sell the house. He's wrong, but what do you want to do? And she said, oh, forget it, just use the title company. We used the title company. Everything was great. They were a great title company, but that wasn't the issue. And because he had put it in writing in an email, if you don't use this title company, we're not going to sell you this house. When everything was done and over, I gave her the email and she was able to go to the small claims court and sue for 3 times the amount paid for title insurance. Another word for that, you guys need to know it, is treble damages. Why? Because he made it a condition of the sale. If you don't use this title company, we're not going to sell you this house. Well, that's a direct violation, which he put in writing, of RESPA Section 9. So they're going to ask you, what law allows the borrower to sue for 3 times the amount paid for title insurance? Well, when I hear the word title, I don't need to hear anything else. Title equals Section 9. Anything about title, Section 9. Or they may say, what law allows the borrower to sue for treble damages? Make sure you know treble damages is a legal term that simply means 3 times the amount. That's what you need to know. RESPA Section 9 is about title insurance. RESPA Section 10 is about escrow accounts. What are 2 other words? Someone type it in the chat. What are 2 other words that I told you that they may use instead of the word escrow accounts? Herb has it, impound and reserve. Impound and reserve. So Section 10 deals with escrow accounts, otherwise known as impound accounts and reserve accounts. It sets the limit on how much the lender can require the borrower to put into an escrow account. You need to know what they can do each month and what they can do at closing. Each month, the lender can require the borrower to pay no more than 1/12 of the annual disbursement. Highlight 1/12. Why do they say 1/12? Because there's 12 months in a year. So what was going on is that these lenders in January, they were taking the taxes and insurance for the first quarter with the first payment. And then in April, they would take the taxes and insurance for the second quarter. And in July, on and on. And the CFPB said, no. Each month, you can take no more than 1/12. Take their taxes divided by 12. Take their insurance divided by 12. The question is going to be, what law, what rule, what regulation says that the lender can take no more than 1/12? RESPA Section 10. Then it also says at closing. What are the other 3 words that they may use besides at closing? I told you 4 that they use interchangeably. At closing, at loan settlement, at loan consummation, at doc signing. They can take a cushion, highlight cushion, of no more than 2 months. A cushion. Now, this is where people tell me, I'm a notary and I've seen the paperwork and they took way more than 2 months taxes at closing. I didn't ask you how much taxes did they take, because if the taxes is due, they can take the next 6 months taxes, but on top of that, they can take a cushion, a buffer, but of no more than how much? 2 months. Answer what they're asking. Did they say how much taxes can they take at closing? You're not going to get that question. They're going to ask you how much of a cushion can they take at closing. What if their insurance went up during the year? What if their taxes went down? The lender has a cushion, a buffer. How much of a cushion? What is the max cushion they can take at closing? 2 months. RESPA Section 10, it also requires that they conduct an annual escrow analysis. And people get this question wrong even on my exam. They're going to ask you, how often is an annual escrow analysis performed? And they're going to have their 6 months, 12 months, 24 months, 48 months. How often is an annual escrow analysis performed? Every 12 months. Annual means 12. Now, what is an annual escrow analysis? That's when they have to look at all the taxes they took with your payment, all the insurance amount they took with your payment, and then they need to show that they paid it, And at what point would they owe money to the borrower? If they found that they took $50 or more, $50 or more, I would say over $50, so it would be $51. Over $50 too much, they have to return it to the borrower. And in your notes, write in there, within 30 days. So if they do their annual escrow analysis and they see that they took over $50 too much, they have to return that amount to the borrower within 30 days. So here's a quiz. The CFPB was created by, you guys tell me, A, B, C, or D? Very good. A. Under RESPA section what? It is illegal for a property seller to require the borrower to use a particular title company. Under RESPA section 9. So the answer is C. You have to know what 6 items make up a complete application. You have to know what 6 items make up a complete application. These are the 6 items that make up a complete application. And you need to know that number 5, what can and cannot go there. For number 5, where it says address of subject property, if it's a refinance, you know the address, so no big deal. If it's a purchase, you may not know the address. So things that can go there would be TBD, to be determined, and UNK, unknown. But what can never ever go there, and they're going to ask you this, what can never ever go there is N/A, N/A. But you do need to know what items make up a complete application, because if the lender, the creditor, the bank gets a complete application, then they have to give out what's called the initial disclosures. And I'm going to go into details on what's the initial disclosures. But if a creditor, a bank, a lender receives these 6 items, they have to give out the initial disclosures. Unless, and you need to know this, unless the applicant withdraws the application within the first 3 days, or the lender turns it down within the first 3 days. A lot of people don't pass this test because they don't know the exceptions to the rule. When would the creditor have to give out the initial disclosures? At or within 3 days of the application, unless the applicant withdraws the application within the first 3 days, or the lender turns it down within the first 3 days. Otherwise, they have to give out the initial disclosures. Now take a look at this chart. A couple of things I want to have you write before I even go over the chart. The first thing, I need to make sure that you understand what TRID is. TILA RESPA Integrated Disclosures, TRID. When the CFPB took over, they looked at a bunch of the TILA disclosures, and there were a lot of them. and they looked at a bunch of the RESPA disclosures, and there were a lot of them. And a lot of the TILA disclosures said the same things as a lot of the RESPA disclosures. So they took some and they integrated them, and they got rid of others. TRID stands for TILA, RESPA, Integrated Disclosures. And this is the TRID timeline that we're getting ready to go over. But first, make sure you understand what TRID stands for. TILA, RESPA, Integrated Disclosures. The next thing that I want you to write somewhere in your notes is that RESPA deals with timing. RESPA deals with timing. RESPA is more concerned with when certain items have to be given out, not so much what. We're going to talk about what has to be given out under RESPA, but RESPA deals with timing, when certain items have to be given out. And if you look over here, these are the time frames. These are the items that have to be given out at or within 3 days of the application, according to RESPA. These are the items that have to be given out before settlement. Where it says before settlement, I want you to write before doc signing, before they sign docs, at the actual doc signing, at the actual doc signing. And after means even though the docs are signed, these are items, according to RESPA, that have to be given out. RESPA deals with timing, when certain items have to be given out. And according to RESPA, there's 4 different time frames. At or within 3 days of the application, before settlement, meaning before doc signing, at settlement, meaning at the doc signing, and after, meaning after doc signing. RESPA deals with timing. I want you to put a circle around everything I have here. And I need you to make yourself a note that these items here are called the initial disclosures. They're going to ask you, which of the following is one of the initial disclosures, which is not one of the initial disclosures. These items here are the initial disclosures. When does the bar get the initial disclosures? At or within 3 days of the application, unless the applicant withdraws the application within the first 3 days, or the lender turns it down within the first 3 days. What are the initial disclosures? All of these items here. When do they get them? At or within 3 days of the application. What are the exceptions? If the applicant withdraws the application within the first 3 days, or the lender turns it down. Now, let's talk about each one of these initial disclosures. Remember, I told you that they have 3 ways to almost ask anything. The first initial disclosure is called the Home Loan Toolkit, but it's also called the Know Before You Owe booklet, but it's also called the Special Information Booklet. 3 names for the same thing. Just like you can call me Artricia, you can call me Trish, you can call me Miss Woods, same thing. The Home Loan Toolkit is also the Know Before You Owe booklet. It's also called the Special Information Booklet. And look at this note here, because that's what people forget, and they get it wrong. For purchases only. When would they get the Home Loan Toolkit? When would they get the Know Before You Owe booklet? At or within 3 days of the application, if it's a purchase. It's a book that explains how purchases work. They're going to give you 4 scenarios, and they're going to ask you which borrower will get the Home Loan Toolkit, or which borrower will get the Know Before You Owe booklet. The one that's making a purchase, not the one that's getting a refi, not the one that is getting a reverse mortgage, the one that's actually purchasing. They will get the Know Before You Owe booklet, the HUD Special Information Booklet, the Home Loan Toolkit. The next one here is the loan estimate. Make yourself a note. Formerly, it used to be called the GFE, the good faith estimate. In purchases and refinance, we don't use the GFE anymore. We use the loan estimate. We use the loan estimate. It replaces the loan estimate. Now notice I have here TILA. And listen to me carefully. It's a TILA document. RESPA just says when they have to get it, because RESPA deals with timing. If I asked you what law, what rule, what regulation says that they have to get the loan estimate, the answer is TILA. But if I say what law says they have to get it at or within 3 days of the application, the answer is RESPA. RESPA deals with timing. Who says they have to get the loan estimate? TILA. But who says they have to get it at or within 3 days of the application? RESPA. Why? Because RESPA deals with timing. You're going to have to make sure you get that. Another initial disclosure is the mortgage servicing disclosure statement. And highlight what I have here, the lender's intentions. Within 3 days of the application, the lender has to tell you whether they're going to service the loan or if later they're reserving the right to let someone else service it. When I first got my house, it was with IndyMac, but they told me that I may not always be making my payments to IndyMac. The servicing of it may go to someone else. And it went to Aqua and SLS and on. But they told me their intentions. They're going to ask you what document tells the lender's intentions as to whether or not they're going to service the loan as well. So I'm Bank of America. We're going to fund your loan, and you're going to make your payments to us forever for the whole 30 years. Or I'm Bank of America. We're going to fund your loan, but we're reserving the right. It may be 5 years from now, 10 years from now, maybe 5 days from now. We're reserving the right to let someone else service it. It tells their intentions. When do they have to give you their intentions? At or within the first 3 days. That's the mortgage servicing disclosure statement. And they also have to give them a list of HUD approved counselors. And make yourself a note. The list has to have at least 10 HUD approved counselors on it. They have to give this because sometimes the CFPB found when they were interviewing borrowers, what were some of their issues. And their issues was, my real estate agent didn't have any answers for me. My loan officer didn't have any answers for me. The title company didn't, they were all confused. Who can I talk to that doesn't have a financial gain in this whole situation that I can trust? So now they have to get a list of HUD counselors. These are all the initial disclosures. When do they get them? At or within 3 days of the application, unless the applicant withdraws the application within the first 3 days, or the lender turns it down within the first 3 days. Now, before settlement, before doc signing, if you refer them to a business that you also have part ownership in, they have to get the AFBA disclosure, 1%, not 10%. But they also get what's called the closing disclosure. Make yourself a note. That used to be the HUD. We don't use the HUD anymore for refinance and purchases. We use the CD, the closing disclosure, and they get it 2 times. 1, 3 days before to review, and then they get it again at the doc signing. And it better be the same, because if it isn't the same, then they get a new one, and they get a new 3-day waiting period. Notice, it's a TILA document. What law says they have to get the closing disclosure? TILA. But what law says that they get it 3 days before doc signing and they get it again at the doc signing? RESPA, because RESPA deals with timing. Also, they will get the initial escrow statement. Initial escrow statement, sometimes that's called the hello letter. Write that down. Sometimes it's called the hello letter. It tells them how much their taxes and insurance is going to be. Hello, you're going to be paying taxes and insurance of this amount, and we're going to include it in your payment. When do they get that? They normally get it at settlement, but here's the question you're going to get. But if they did not get it at settlement, how long does the lender have to get it to them? 45 days. 45 days. So the question is going to be, normally the initial escrow statement is given at settlement, at doc signing, at loan consummation. However, if it was not, how long does a lender have to provide it? They have to provide it within 45 days. Now, after doc signing, if their taxes and insurance were included, if their taxes and insurance were included, they're going to get an annual escrow statement. We talked about that in RESPA Section 10. Also, if their loan was transferred to another servicing company, they would get the servicing transfer statement. Up here, they told them, we don't know. We'll let you know if we do. Down here, the servicing transfer statement, they also called it the goodbye letter. Goodbye. Don't send your payments over here to us at IndyMac anymore. We transferred the servicing of your loan to Ocwen or SLS or checks. The servicing transfer statement means they actually transferred the servicing, not the loan, but who you make your payments to. They call it the goodbye letter, and the borrower must get it 15 days prior to the transfer. 15 days prior to the transfer, so they know where to make their payment. But there's no penalty for the first 60 days. What if I didn't open my mail and I didn't know that it was transferred and I still sent it to my old lender? I won't be able to have a late payment. I won't have a credit ding. They'll fix it themselves for the first 60 days. But after 60 days, I should know where to make my payment. So there's no penalty for the first 60 days. All of these disclosures here on this page are RESPA disclosures except for two. Which two are they? Every disclosure on here is a RESPA disclosure except for two. The loan estimate and the closing disclosure. Those are TILA disclosures. RESPA just says when they have to get them. So when they ask you what law says that they have to get the list of HUD counselors, RESPA. What law says that they have to get the initial escrow statement? RESPA. What law says that they have to get the servicing transfer statement? RESPA. But if they ask you about TILA, they ask you about the loan estimate, or they ask you about the closing disclosure, those are TILA documents. No fee, except for the credit reporting fee, can be charged before the borrower gets the loan estimate. So you have to understand that the loan estimate is an estimate of what the fees are going to be. It's an estimate of what the fees are going to be. And the borrower cannot be charged for anything other than a credit report until they have agreed to that estimate. The terms on that estimate must be available. They cannot be changed for 10 days. So again, the loan estimate is an estimate, and the terms on that loan estimate must be good for 10 days. Now, when they get the closing disclosure, it's no longer an estimate. It is the actual terms. It is the actual terms. And again, guys, remember, if it's not something that's going to be on the test, we're not going to talk about it right now. The creditor must be completed for the borrower. They're going to ask you, who completes the loan estimate for the borrower? The bank. That's who they're getting the money from. Then they're going to ask you, who completes it for the seller, the settlement agent, the title agent? The question used to be, who completes the HUD? And the answer was title. Well, there's no HUD. So who completes the closing disclosure for the borrower? The creditor. Who completes it for the seller? The settlement agent, meaning escrow. Remember, they get it 3 days before doc signing to review, and then they're going to get it again at doc signing. It better be the same. Why give me something to review, and then when I get to the final setting, it's totally different? What was the point of having me review it? If any of these 3 things change within that 3-day waiting period, they have to get a whole new closing disclosure and a whole new 3 days. If the APR changed, maybe the loan originator didn't lock the rate, and within the 3 days, the rate changed. Highlight the 1/8 and the 1/4. If they went up or down by more than these amounts, they have to get a new closing disclosure and a new 3-day waiting period. What if within that 3 days, the borrower says, you know what, I don't want an adjustable anymore. I want a fixed. Let's change this whole thing to a fixed. They have to change it, and there's a new 3-day waiting period. Or what if at the last minute, the lender says, you know what, we want a prepayment penalty. We want a prepayment penalty. They have to disclose that, give them the new documents, and they have 3 days to decide if they still want it. That is the closing disclosure. So TILA, the Godzilla. TILA, the Godzilla. TILA deals with credit, APR, and advertising of loans. TILA deals with credit, APR, and advertising of loans. TILA is Regulation Z. We call it TILA, the Godzilla. The purpose of TILA is to require the lender to disclose the complete cost of credit. The complete cost of credit, meaning they need to tell us the whole story up front. Yes, you're buying this house for $300,000, but after 30 years, it will have ultimately cost you blank. They have to give you the complete cost of credit. Yes, you're buying this car for $12,000 at 7% interest rate. So after 5 years, it will have cost you blank. What law, what rule, what regulation requires the lender to disclose the complete cost of credit? That will be TILA. TILA also requires that the lender disclose to you the APR, the annual percentage rate. That's a question. What law requires that they disclose the APR? That will be TILA. Now, TILA applies, listen to me, when there are more, circle or highlight more than 4 installments. Well, what does that mean? What it means is if you buy anything on credit, house, car, boat, ring, laptop, anything, and you're going to pay for it on credit in more than 4 installments, TILA rules and regulations kick in. Have you ever watched Home Shopping Network? If you watch Home Shopping Network, sometimes they keep things to 3 payments or less, 4 payments or less. Why? So they don't have to deal with TILA, because TILA rules and regulations don't kick in until there's something on credit in more than 4 installments. The question I got on my test was, which are the following? More than 3, less than 3, more than 4, less than 4. You have to remember more than 4 installments. They're not going to just say 5. It's going to say more than 4 installments. The only fee that can be collected before TILA disclosures is for the credit report. TILA is also the law that established the 3-day right of rescission rule. They're going to ask you what law established the 3-day right of rescission rule. TILA. And write down exactly what I'm saying, and I'll type it in the chat. If it's a HELOC or a refi, and I'm not saying or, and it's their primary residence, the bar has 3 days to rescind, to change their mind, to back out, but only if it's a HELOC, refi, and primary residence. So I'll say that again. If it's a HELOC, a home equity line of credit. Why? Because they're taking money out on their house. If it's a refinance, why? Because they're starting their loan over again. And if it's their primary residence, why? This is the house you live in. Are you sure you want to do this? If it's a HELOC or refinance and their primary residence, a bar has 3 days to back out. Even though they signed the documents, they have 3 days to rescind. But if it's a purchase, no. If it's a second home, no. If it's an investment property, no. Only if it's a HELOC, home equity line of credit, a refinance, and their primary residence. If it's a purchase, no. What if it's an investment property? No. What if it's a second home? No. It only takes one borrower to rescind. Maybe 4 of us are going together on a loan. If one backs out, it's dead for the rest of us. We have to start over. Rescission is up at midnight of the 3rd day. Midnight of the 3rd day. And the day they sign is not day 1. The day they sign is not day 1. So if a borrower signs docs on Monday, when is the rescission period up? Well, you can't say, well, Monday is day 1. No, it isn't. Tuesday is day 1. Wednesday is day 2. Thursday is day 3. And it's not up until midnight on Thursday. If money was collected for any reason, how long does escrow have to return it? 20 days. 20 days. And we're going to talk about business days and calendar days in a minute, but 20 days. Each borrower must get 2 copies of the right to rescind. Well, what if there's 4 people on the loan? Well, each of them must get 2 copies of the right to rescind. How long must TILA records be kept? That's going to be a question. And you need to know the general rule, and you need to know the exceptions to the rule. How long must TILA disclosures be kept? If they just say TILA disclosures, the answer is 2 years. If they specifically ask you about the loan estimate, the answer is 3 years. If they specifically ask you about the closing disclosure, the answer is 5 years. What are the TILA disclosures? These are all the TILA disclosures. Take a look at them. The loan estimate and the closing disclosure, those are TILA documents. But RESPA says when they have to be given out. But they're truly TILA documents. Also, there's one called the CHARM booklet. You need to know what CHARM stands for and when the borrower will get the CHARM booklet. The CHARM booklet stands for Consumer Handbook on Adjustable Rate Mortgages. CHARM, Consumer Handbook on Adjustable Rate Mortgages. And when would the borrower get the CHARM booklet? When they're getting an adjustable rate mortgage. Sounds simple, but they're going to give you 4 stories. And they're going to ask you which of these borrowers will get the CHARM booklet. They're going to say, Sue is getting a reverse mortgage. No. Danny is getting a fixed rate mortgage. No. Mary is getting an adjustable rate mortgage. Mary would get the CHARM booklet because the CHARM booklet stands for Consumer Handbook on Adjustable Rate Mortgages. The other booklet is called the When Your Home is on the Line booklet. And it explains how HELOCs, home equity line of credit, and refinances work. Well, when would a borrower get the When Your Home is on the Line booklet? When they're getting a HELOC or when they're getting a refi. If they're not getting a HELOC or a refi, they don't need that document. Every borrower would get the notice of the right to rescind. They would actually get two. And if they have an adjustable rate mortgage, these other two disclosures they would get as well. What was going on is that borrowers would get an adjustable, and it would be fixed for 5 years, and then it would start to adjust. And that borrower got used to that payment, and they didn't remember in year 5 that the payment is going to adjust. And when the payment adjusted, they weren't ready for it. Well, the CFPB says the lender should give them a notice. The first notice that they get, and these are out of order, is the initial rate disclosure saying, hey, remember, this was an adjustable. To get that to them 7 to 8 months ahead of time. Remember that this is going to adjust in the next 7 to 8 months. Start adjusting your life. This is an adjustable. And then 60 days before, that's what I have in number 5. They're going to say, hey, remember, this is an adjustable. And in 60 days, your payment is going to change. That gives the borrower time to either refinance out, pay it off, stop eating out so much, turn off some lights, whatever it is that they need to do. But these are the TILA disclosures. TILA disclosures. TILA requires that they provide the APR, and you need to know that another word for APR that they'll use on the test is effective rate. They may never say the word APR, annual percentage rate. They may say the effective rate. And you need to know the two other words that they use for interest rate. They call it the note rate and the nominal rate. The note rate and the nominal rate. So know the other word for APR and know the other two words for interest rate. Understand that TILA is the law that created the definition for a business day. TILA is the law that created the definition for a business day. And it says all calendar days except for Sunday and legal holidays is a business day. So they're going to ask you what law says Saturday is a work day. TILA. Because TILA says all calendar days except for Sunday and legal holidays is a business day. The only exception is if they're talking about the loan estimate. And on the exam, they will say, as it relates to the loan estimate, then you know that that's something different. But if they didn't say that, a business day is any day that's not a Sunday or a legal holiday. But for the loan estimate, it's any day that that business is open. What if there's a supermarket bank and they're open on Sunday, or they're open on Labor Day? They're open. If the loan estimate is due, is any day that that business is actually open. I also told you that TILA mandates advertising. I told you TILA deals with credit, APR, and advertising. TILA deals with credit, APR, and advertising of loans. You need to know what a triggering term is. A triggering term is if they use it, then now they have to give additional information. It's a triggering term. If the APR is not given, it triggers. Look at this first box. If they use a number to describe any credit terms, and that number is not the APR, then it triggers additional information that has to be shown. For example, they may have to show number 1, number 2, and number 3 there. But look at the second box. If they give you the APR or they use generic terms, then there's nothing else needed. There's nothing else needed. You're going to be given some terms, and in those terms, you're going to have to determine if it's a triggering term or not. This is my definition of a triggering term, and I'll type it in the chat box. If they use a number to describe credit terms, and that number is not the APR, then it triggers. What do I mean when I say it triggers? Now they have to give the amount or percentage of the down payment. Now they have to give the terms of repayment. Now they have to put the words APR spelled out. So all of these will require that, because they're 20% down. That's not enough information. 20% down of what? $700 a month for how long? But if they use generic terms in advertising, or they give the APR, they don't have to give anything else until the person actually does an application. Remember, this is advertising, and some people will ask you 1,000,001 questions, and then they go take their business to someone down the street. You need to know the minimum that you have to give out until they actually come in and work with you. Qualified mortgages. This is still a part of TILA. Qualified mortgages. You will get questions on this because this is relatively new. And people think it has to do with whether or not the borrower qualifies for the loan. No, it has nothing at all to do with the borrower. It has to do with whether or not the lender, the creditor, qualifies for what's called safe harbor, legal protection. So what they're doing is they're telling lenders, we know that it's hard out there, okay? And we know that you guys are losing a lot of money by people going into foreclosure. Let's do this. We're going to give you some criteria. If you make a loan based on this criteria and that borrower still goes into foreclosure, you're going to have what's called safe harbor, legal protection, bailout. We will come back and we'll give you everything that you lost. But what if the borrower doesn't fit into that criteria? Well, you're Bank of America, you have plenty of programs. Put them in any of the other ones that you have. When you turn in a loan these days, the first thing the lender is going to do is, oh my God, let me see it into this category. Because if they do and they go into foreclosure, we don't care. They're going to give us the money back. Oh, they don't fit into that category? Okay, what other programs can we put them in that we already have? You need to know what makes it a qualified mortgage to qualify for safe harbor and what doesn't. And it's an all or nothing thing. So this is what makes it a qualified mortgage. They want the borrowers to be able to go full dot. So those things that used to happen in the past, no dot, no income, no assets stated, they're not going to do the guarantee based on any of that. The maximum back-end ratio cannot be higher than 43%. The loan originator cannot charge more than 3 points. The long term cannot be over 30 years. There's people doing 40-year loans. They wouldn't qualify for this. The bank wouldn't qualify for the bailout money. And they don't want any of those things that got us in trouble in the first place. Interest-only loan, negative AM, teaser rates like pick-a-pay. They're not saying that these things can't be done. They're just saying that they're not going to bail you out of those kind of things. And if you're going to give them an adjustable rate mortgage, you have to qualify them based on where they will be in 5 years, so that the lender will feel comfortable that they can at least afford this loan for 5 years. So this is how these questions are going to go. They're going to say, which of the following is a qualified mortgage and which is not? And you guys type your answers in. Susan got a 30-year loan. The loan originator is charging 2.5 points. She's able to go full doc, and her back-end ratio is 46%. Yes or no? No. Danny got a loan. His back-end ratio is 42%. He was able to go full doc. It's a 15-year loan. Yes or no? Yes. It said it cannot be over 30 years. Mary got a loan. She's going full doc. Her ratio is 42. It's 30 years, and the loan originator is charging her 3.25%. No. It's an all or nothing thing. It's an all or nothing thing. And it's to protect the lender. They're telling the lender, if you do a loan under these guidelines for Artricia, and Artricia goes into foreclosure, we're going to give you back all the money that you lost on Artricia. But if Artricia does not meet these criteria, you don't have safe harbor. You're going to take the regular risk that you take on any other loan that you do. So the first thing the lenders want to do is see if you fit into this. And if you don't, like I said, they're Bank of America, they're Chase, they're Wells Fargo. They have plenty of other loans that they can put you in. They just won't have what's called the safe harbor. Prepayment penalties prohibited. You also need to know about the ability to repay. Ability to repay, you need to know all 8 of these. What are the 8 things that the lender must look at to make sure that the borrower has the ability to repay the loan? And the reason why this came into place is because some people got into loans and they couldn't even make their first payment. They foreclosed, they couldn't make their first payment, their second payment. That's because they were allowed to go stated or no doc or Nina because they had a great credit score. You had people working at McDonald's making $10 an hour with a 750 credit score, and they were going stating that they were a sanitation engineer making $24 an hour, but they were really only making $10 an hour. And when it came time to make the payment, they couldn't afford it because they were only making $10 an hour, and they got qualified based on $24 an hour. Now, before any loan can be done, the lender must prove that the borrower has the ability to repay. And on the exam, they're going to ask you, what are the 8 items that the lender must verify to show that the borrower has the ability to repay? Because if they give them a loan and that borrower goes into foreclosure within the first year, and then the federal government goes back and look at the file, and they don't have these 8 items in there showing why they gave it to them, they're going to make them buy back the loan. A lot of lenders are having to buy back loans. Why? Because they didn't make sure at the time they gave the loan that the borrower had the ability to repay, or they didn't have proof of it. So these are the 8 items that the lender must look at to verify that the borrower actually has the ability to repay the loan. And these you just have to remember. I've been trying to think of some tricky kind of way, but just cold, hard remembrance. Okay, here's a quiz. TILA applies when credit is payable and written in more than, you guys tell me, A, B, C, or D. A, more than 4 installments. How long must the closing disclosure be kept? 5 years, so that will be A. So we're going to talk about ECOA. ECOA is the Equal Credit Opportunities Act, and it's about discrimination when granting credit. I need you to remember this. There's 2 laws that deal with discrimination. And a lot of time I get a question, where a person wants to argue with me saying, but you said ECOA was about discrimination. But you said fair housing was about discrimination. ECOA is about discrimination when granting credit, when someone's applying for credit. Fair housing is also about discrimination, but it's about discrimination in the sale and lease of property. They're both are about discrimination. One deals with discrimination when someone's applying for credit. The other deals with discrimination in the sale and lease of property. Two different things. We're going to talk about ECOA right now. The entire purpose of ECOA is to give everyone an equal chance to obtain credit. It shouldn't be different because I'm female and you're male. It shouldn't be different because I'm Catholic and you're Muslim. It shouldn't be different because I'm Black and you're white. No. Everyone should have an equal chance to obtain credit. ECOA is Regulation B. The regulators should be equal when disseminating or approving credit. If someone applies for credit, the creditor has 30 days to give them an answer on a credit application. If they give out what's called an adverse action notice, that's a fancy word for a denial letter. Again, if you get a notice that says adverse action notice, it's just a fancy word for a denial letter. ECOA disclosures must be kept for 25 months. That is not an error. Okay, that is not an error. How long must ECOA disclosures be kept? 25 months. Why? Because a person has up to 24 months to sue under ECOA. So what if you waited to the very last minute, to the 24th month? That's fine because the records are kept for 25 months. Make sure you get that and you don't get that wrong. ECOA records must be kept for 25 months. How long does a person have to sue for ECOA violation? 24 months. According to ECOA, the only way you can ask about marital status is, are you married, unmarried, or separated? According to ECOA, the only way you can ask about marital status is, are you married, unmarried, or separated? You cannot go around asking people if they're single. So unless you're in some nightclub or somewhere, don't ask, are you single? Ask, are you married, unmarried, or separated? But they're going to ask you according to what law? According to ECOA. According to ECOA, and I don't know why this is under ECOA, okay, but it is. And like I say, I didn't make the rules. I'm just telling you what the rules are. You cannot ask them questions about their childbearing or child rearing, or write yourself a note in there, or birth control methods. Yes, they actually ask that on the test. You cannot ask them questions about their childbearing, child rearing, or birth control methods. You can't say, well, this is a 2-bedroom, 2-bath, and I see it's your husband and you already have 2 kids. This is kind of small. Do you guys plan on having any more? You can't ask them about their childbearing, child rearing, or birth control methods. Or this guy here, he's pretty big. He's 25 years old. I know he's your son, but how long is he going to stay here? You can't ask them questions about their childbearing, child rearing, or birth control methods. But the question is, according to what law? That's the part. According to what law can you not ask those questions? And you need to know ECOA. The penalty for violating ECOA is $10,000. A protected class is a class of individuals that The creditor cannot use these as the reasons to deny someone, because consumer is protected under these. And notice I have some in black and some in red. ECOA has eight protected classes. Highlight the ones in black and make yourself a note that those are also protected by fair housing. Put a circle on the ones in red and make yourself a note that those are only protected by ECOA. So when I say protected class, a creditor can't look at your sex and deny you. Oh, you're a female? We don't give loans to females. They can't do that. That's a protected class. Race? Oh, so you are Filipino? They can't do that. Religion, color, national origin. But ECOA goes a step further. Age. So this is a Maserati, and you look to be about 90 years old. No, we think you're too old for this. They cannot deny you based on your age, your marital status, or receipt of public assistance. Public assistance is any income that's non-taxable. And you guys are just gonna have to go with me for this, because for the test, and what you may be thinking, two separate things. For the test, public assistance means Social Security income, child support income, alimony, pension, retirement, disability, foster care income. There's tons of them. Non-taxable income. And this is where people want to argue with me, but you could tax it if you want. That wasn't the question. And thinking like that is not going to get you to pass the test. These are considered non-taxable income. And people want to say, but you can tax them if you want. That wasn't the question. Answer what they're asking. And they cannot deny you based on your receipt of public assistance. An underwriter can't look at your file and say, I see that you get $2,500 a month, but it's all Social Security. We can't use it. Yes, you can. That's considered public assistance. Or child support. I see that you get $5,000 a month. I see 5 deposits of $1,000 a month, but this is all child support. That's not a real job. Oh, yes, it is. I worked a lot. I may have 5 baby daddies, each giving me $1,000 a month. They cannot deny me based on my receipt of public assistance. ECOA is also the law that deals with appraisals. You need to know the following. ECOA is the law. ECOA is the law that says that a borrower has a right to receive a copy of their appraisal. ECOA is the law that says a borrower has the right to receive a copy of their appraisal. That's number one. What law gives the borrower the right to receive a copy of their appraisal? In a home loan, ECOA. In fact, they have to send the borrower a letter within the first 3 days notifying them that they have this right. So within the first 3 days, they're going to send them a letter saying, hey, you applied for a home loan. We want to let you know that once this is done and there's an appraisal, you're going to get a copy of it. Now, I didn't say that they're going to get the appraisal in the first 3 days. I said that they're going to get a letter notifying them that they have a right to receive a copy of their appraisal. They're going to get that letter notifying them of that right within the first 3 days. If the application is denied based on appraisal, the borrower has the right to request it within the first 90 days, and the lender must provide it within 30. If it was denied. But if it's approved, when do they get it? 3 days prior to doc signing. Know when they're going to get it if it's denied. Know when they're going to get it if it's approved. Know what law says they have the right to get it in the first place. Fair Housing Act. Also about discrimination. But Fair Housing Act is about discrimination in the sale and lease of property. It has 7 protected classes. Look at the first 5. They're the same as ECOA. But then the last 2, disability and familiar status, those are only for fair housing. You can't deny selling or leasing me a property because I have a disability or familiar status because I have kids or because I'm pregnant. Fair housing has 7 protected classes. The first 5 are also shared by ECOA, but it has 2 additional. You need to know what's protected by ECOA and what's protected by fair housing and what's protected by both. A person has 1 year to file a lawsuit under the Fair Housing Act, 1 year to file a lawsuit under the Fair Housing Act. How long do they have to file a lawsuit under the ECOA? 24. That's one thing. But how long are ECOA records kept? ECOA records are kept for 25 months. So you have to know the difference because they're going to try to trick you. There are 3 laws that come under the Fair Housing Act, and you need to know that they come under the Fair Housing Act: blockbusting, steering, and redlining. A lot of people want to say that they come under TILA because we think everything comes under TILA, the Godzilla, but not these 3. Don't get tricked. If you need to make yourself a note, make yourself a note now. Blockbusting, steering, and redlining are under the Fair Housing Act, not TILA. So let's talk about blockbusting. Trying to get someone to sell their house by saying that another ethnicity just moved in the neighborhood and now your rates are going to go down. They would knock on the doors. Did you notice a Black, an Asian, a Latino just moved in your neighborhood? Here's my card. You might want to sell now because you know your values are going to go down now. So you might want to get out. Another word for blockbusting, panic selling. Write that down. Another word for blockbusting is panic selling. Trying to panic them into selling by saying because another ethnicity is moving in the neighborhood, that's going to drive values down. You better get out now. Blockbusting, panic selling. Steering is the opposite. Trying to channel them to a particular neighborhood based on their race, religion, or ethnicity. You are Armenian. Let's find a good Armenian neighborhood for you. You can't say that. You're Muslim. Let's find a good Muslim neighborhood for you. Or are you African American? You're Filipino. You're anything. You cannot channel them to a particular neighborhood based on their race, religion, or ethnicity. They can steer themselves, but you cannot steer them. For example, I'm African American. My brother's married to a Filipino. When she came over, she said, I only want to live in La Palma. There's a lot of Filipino people in La Palma. I can make a lot of friends. I'll feel comfortable. Don't show me anything except for La Palma because that's a Filipino area. She did that. But I couldn't have said, hey, Jocelyn, you know you're Filipino, right? You better stick over here with the other Filipinos. I would have been guilty of steering. I would have been guilty of steering. Now, they're going to ask you, who commits the discriminatory practice of blockbusting and steering? And the answer is real estate agents. Who commits the discriminatory practice of blockbusting and steering? Your answer is going to be real estate agents. Redlining is refusing to make loans for discriminatory reasons. A lender does that. They would put a map on a wall and they would draw a red line through certain areas. They would put a map on the wall, draw a red line through certain areas. They said, don't lend to this area because it is this. Don't lend to this area because these people are that. That's where the term redlining came from. All of these are under the Fair Housing Act. Make sure you understand what I'm about to say because people get it confused, so listen carefully. Redlining is the law that led to the creation of HMDA. Redlining is the law that led to the creation of HMDA. Redlining is the reason why we have HMDA. Redlining is not under HMDA. They're going to ask you, what law is redlining under? And people want to say HMDA. No. Redlining is the reason why we have HMDA. Redlining, because of all the redlining, they created HMDA. Redlining is the law that led to the creation of HMDA. Redlining is not under HMDA. Redlining is under the Fair Housing Act. They're going to ask you, redlining is under what law? And they're going to have their TILA, HMDA, ECOA, Fair Housing. Redlining is under Fair Housing. But redlining led to what? Because of all the redlining, now we have what law? HMDA. Now look at this chart. You guys want to make sure that you understand this chart. It's all about ECOA and fair housing. It tells you what's protected by both. It tells you what's protected by both. And it tells you what's only under ECOA, look what's in the red, and what's only under fair housing. Age is only under ECOA. Marital status is only under ECOA. Receipt of public assistance is only under ECOA. They're going to ask you what's protected by both, what's protected by only ECOA, what's protected by only fair housing. And you'll see some examples of that when we do our quiz next. HIPAA, Homeowners Protection Act, HIPAA. I told you it's all about PMI, private mortgage insurance, PMI. And you want to keep it simple. For the exam, you just need to know, when can the borrower request cancellation of the PMI? I am not saying MIP. When can the borrower request cancellation of the PMI? When the balance of the loan is at 80. Or they may say when it's been paid down by 20%. If they pay it down by 20%, how much is left? 80. But then they're going to say, when must the lender cancel the PMI? When the balance left is 78. Or when it's been paid down by 22%. If they pay the loan down by 22%, how much is left? 78. Just know those two things. When the balance is at 80, the borrower can request. The lender can say yes or no. But that wasn't the question. The question was, when can the borrower request? When the balance is at 80. And the second question is, when must the lender do it? They don't have a choice when the balance is at 78%. And HIPAA is about what? PMI, PMI, not MIP. Here's our quiz. Which regulation is designed to ensure that all consumers get an equal chance to obtain credit? C, ECOA. Now this one you got to kind of refer to that chart and think it through, because this is exactly how they're going to look. The Fair Housing Act prohibits discrimination based on race, color, religion, sex, and think it through and tell me what you think. So it can't be A, because A has age in it, and that's only under ECOA. It can't be B, because B has marital status, and that's only under ECOA. Can't be D. We didn't even say anything about sexual orientation. So the only possible answer is C. HMDA, Home Mortgage Disclosure Act. HMDA, Home Mortgage Disclosure Act. It's Regulation C. What does it do? It allows regulators to see where possible discrimination takes place. Where do they see it? Section 10. Remember I told you that Roman letter X? Section 10 of the 1003 loan application. HMDA requires lenders to file reports regarding the ethnicity, race, and sex of all applicants. Look here. They're going to ask for the ethnicity, the race, and the sex of all applicants. That's what a HMDA report collects. What are the HMDA reports called? Loan Application Registry Reports, LARs. They're going to ask you, what is a LAR? It's a report regarding the ethnicity, race, and sex of all applicants. Now, a couple of things you need to know. So listen carefully. The borrower has the right not to complete this. The borrower has the right not to complete it. However, if the application was taken face-to-face, and another word that they use for face-to-face is visual observation, ECOA requires that the loan originator, the MLO, complete it. So I'm going to type that in there. You need to know if the application was taken face-to-face, visual observation. ECOA is the law, says that the MLO should complete it based on visual observation. Meaning you can't ask them these questions. You cannot ask them, are you Hispanic or Latino? You can ask them what race they are. You can ask them what sex they are. You're supposed to look at them and make a guess. If the application was taken face-to-face, what law says that the MLO should complete it based on visual observation? That would be ECOA. But if you don't, and in my office we don't, HMDA must complete it based on surname. Surname means their last name. So they're going to say Smith, oh, that's Caucasian. Johnson, oh, that's Black. Wynn, oh, that's Asian. So this is how it goes. Whether it's right or wrong, this is how it goes. The borrower should complete it. But if the borrower does not want to complete it, and the application was taken face-to-face, look at what I wrote in the chat. If the application was taken face-to-face, the MLO, us, should complete it based on visual observation. According to who? According to ECOA. We're supposed to look at them and make a guess. If we don't, then how does it get completed? The lender is going to complete it based on surname, their last name. Well, why? Because they have to file these reports in case they get sued by Asian. You didn't give our people loans. They have the reports on how many applied, how many got approved. Female, say you didn't give us loans. Male, they have to file the reports. The rule says, whether we like it or not, ask the borrower to complete it. If the borrower doesn't complete it, ask the MLO to complete it based on visual observation per ECOA. If the MLO does not complete it based on visual observation, how does it complete it? The bank is going to complete it themselves based on surname, based on their last name. And that's just how it works, whether we think it's fair or not. An MLO has the choice. They say they should. In office, we don't. How do I have the right to decide? Okay? We leave it blank and we let it be the bank's issue. And the banks are the ones that have to file the report. So we let them do that based on what their criteria is. FCRA, Fair Credit Reporting Act. FCRA, Fair Credit Reporting Act. It's all about credit reports, and credit reporting agency is regulation V as in Victor. Don't you want to have a very good credit report? FCRA says as a consumer, you have 5 rights. The rights to get adverse action notice, a denial letter in writing. They can't just call and say, nah, Trish, this is not going to work. No, they have to give it to me in writing with a reason. It says we have a right to get a copy of our credit report. We have a right to request the credit score, although they do not have to give you the credit score for free. They do not have to give you the credit report for free. And people want to argue with me and saying, I know companies that do. You might, and that's great. But that wasn't the question. The question says, what law says they must give it to you for free? There is no law that says that they must give you the score for free. There's laws that say they have to give you the report for free, but there's no laws that says that they have to give you the score for free. Also, you have the right to dispute inaccurate or incomplete information. If you get your credit report and something doesn't look right, or you don't think it's right, you can dispute it. You can dispute it, and they have 30 days to investigate it. And you can limit pre-screen offers. Those offers that you get in the mail say you've been pre-approved for this, that, or the other. If you don't want to get those, FCRA gives you the right to dispute those. Adverse action notice is covered by both ECOA and FCRA. FCRA is the one that says that they have to give it to you in writing. In fact, it says any entity that uses a credit report to deny your application must give you the name, address, and phone number of the credit reporting agency they use. For example, we denied you. We use Equifax. Here's their name, address, and phone number. A consumer is entitled to a free copy of their credit report under FCRA. Pay attention to me. When is a consumer entitled to a free copy of their credit report under FCRA? If they got an adverse action notice, if they were the victim of identity theft, if they were the victim of fraud, if they were on public assistance, and we talked about what public assistance is, or if they're unemployed. FCRA will give them a free copy of their credit report. But if one of these 4 things were not their issue, they cannot get a free copy of their credit report under FCRA. So let me tell you what I said, and let me tell you what I did not say. I didn't say that they couldn't get a free copy of their credit report. I said that they couldn't get a free copy of their credit report under FCRA if one of these were not their reasons. So you need to make sure that you know that. When do they get it under FCRA versus any other law? Under FCRA, it has to be one of these 4 reasons. If not, then you need to use another law, and we'll talk about it in a minute, that says that they can get it anytime that they want. The credit report, negative information can't stay on the credit report for more than 7 years. Bankruptcies, more than 10 years. If you're in a state where they put criminal convictions, then those don't expire. They stay on there forever. Now write this down. Write this down. Unpaid tax liens. Unpaid tax liens. stay on your credit report forever. Paid tax liens, stay on your credit report for 7 years. People think if it's an unpaid tax lien, just let it do it 7 years and it'll go away. No, it won't. Unpaid tax liens will stay on your credit report forever. Paid tax liens, it's like negative information. They'll stay on your credit report for 7 years, then they will go away. Under FACRA, you must have a legitimate business need to pull someone's credit. When you get licensed, your mom, your uncle, your cousin, your friends, everyone's going to want you to pull their credit because they're going to go get a car, they're going to go get a whatever, and they want to check out their credit. You can't do that. You have to have a legitimate business need to pull someone's credit, meaning they're doing business with you. You can't just be out there giving people copies of their credit report. In fact, it's illegal for you to give the client a copy of their credit report. And they get so upset with you because they say that I paid you for a copy of my credit report, so you should give me a copy. You cannot. You cannot. They paid you for you to have access to their credit report to make a credit decision. So make sure you understand that. You can't give them a copy of their credit report. That's a violation of FACRA. You cannot give them a copy of their credit report. And they get so upset, but I just paid you $35 for the credit report. No, you paid for me to have access to the credit report to make a credit decision. You have to go to annualcreditreport.com is who is recommended, and you'll see that shortly. FACT Act. The FACT Act is all about identity theft. The FACT Act is all about identity theft. It has a section of rules called Section 114 rules. You need to know that those are just identity theft rules. And this is the law that says you don't have to have a reason to get a copy of your credit report. You don't have to have a reason. In fact, we want you to check your credit report at least once a year so that you can see if there's been any identity theft. The site that's recommended, that's backed by the federal government, and this is a test question, is annualcreditreport.com. Annualcreditreport.com. Not True Credit, not Credit Karma, not any of those little jingles. Those may be fine, but that's not going to be the answer on the exam. The answer on the exam is annualcreditreport.com. Now, the FACT Act requires 3 things, or allows 3 things. The FACT Act requires businesses to truncate, highlight truncate, to truncate debit and credit card information. Truncate means to shorten. Have you ever looked at your receipt when you came out of Home Depot or the grocery store? It has XXXX in the last few digits. That's because of the FACT Act. They can't put your whole credit card number on any receipt. Why? Because of the FACT Act. The FACT Act also says you can password your credit report if you want to. You can freeze it. And it says that MLOs, number 3, must secure and dispose a client's information. What I want you to write there is burn, shred, or keep locked your client's information. Burn, shred, or keep locked. You can't just look at the file and say, oh, I got paid on this one, and throw it in the dumpster. Someone can pull it out and get their information and do identity theft. And when you leave for the weekend or the end of the day, you can't just leave it on your desk. You're supposed to lock it. Burn, shred, or keep locked. What law says you must do that? The FACT Act. Graham-Leach-Bliley Act. The Gramm-Leach-Bliley Act is also known as the Financial Services Modernization Act. I want you to write here, to protect a person's privacy. To protect, that's the main goal of it, is to protect a person's privacy. And it has 3 laws. So when you think of protection, I want you to think of like SPF, like skin protection. So you can remember the 3 things that come under the Gramm-Leach-Bliley Act. SPF, protection. It says that each company or bank must have a safeguarding rules. A safeguarding rule or a set of safeguarding rules, how they're going to keep our information safe. When I go into Target or Walmart or the airport and I use my credit card, I should feel safe because they have some rules on how things are handled. Pretexting, that's a policy that they have to have in place to keep people from pretending as if they're you and getting into your accounts. One example of a pretexting provision is when you try to get into your information online and you put in your password wrong, after a couple of times, it's going to lock you out. And you're going to have to know your mother's maiden name and your high school mascot or all. Those are pretexting policies from keeping people from guessing and pretending to being you and getting into your information. And the last one, financial privacy rule, they have to give you the opportunity to opt in and opt out. Opt in and opt out of how your personal information can be shared. USA Patriot Act is all about anti-terrorism. 9/11, highlight that very last line. That's the question you're going to get. They're going to ask you, what law requires lenders to verify date of birth, social security, and ethnicity? The USA Patriot Act. It's all about anti-terrorism. The do not call list, the DNC list. When you're calling people on the telephone to market your services, that makes you a telemarketer. You're calling them on the telephone to market your services. That makes you a telemarketer. Sometimes we buy leads and we call people on the telephone to say, hey, you want to do a loan to market our services. That makes us a telemarketer, and we have to go by the telemarketing rules, one of which is the do not call list. Before you call anyone on that list, you're supposed to go to donotcall.gov, the government's list, and see if any of those people you're about to call are on the do not call list. And if they're on the do not call list, do not call them. That's how it's supposed to happen. They're going to ask you, how often must you search the do not call list? Every 31 days. How often is the list updated? Now, there's 2 lists that you need to worry about. One is the national list. One is the national list. And the other one is each company, each bank should have their own list of people that call them directly and says, do not call us. Both lists should be updated every 31 days. And records must be kept for 24 months. The penalty for violating the do not call list is $42,000. It went from 10 to 16 to 30 to 41. Now it's at 42. There's only going to be one 40,000 option on your exam. If you have an EBR, an established business relationship, an EBR, and meaning you close the deal with the person, then you can call them for 18 months. Hey, can I help you with something else? Can I help you with something else? Can I help you with something else? Because you actually closed the deal with them. If you didn't close a deal with them, it was just an inquiry, you can only call them for 3 months. Are you ready now? Are you ready now? Are you ready now? But if they ask you to stop calling, you have to stop calling. You can't say, girl, I closed a deal with you. I got 18 months. I'm going to call you every month for 18 months. If at any point they say stop calling, you have to stop. Mars is all about loan mod, short sale, and foreclosure scams. Loan mod, short sale, and foreclosure scams. It bans the collection of fees until a person gets an offer. A lot of people got scammed in loan mods. People took upfront money and they never even got the loan mod. Well, Mars says you can't take any money up front. It also says you can't tell them not to talk to their lender. So they're going to ask you what law says that you can't tell them to discontinue communication with the lender. That will be Mars. The Bank Secrecy Act, which is also called the Anti-Money Laundering Act. The Anti-Money Laundering Act, it's all about money laundering. You need to know what's required by a financial institution versus what's required by us, MLOs. And you see two amounts there, 10,000 and 5,000. So the 10,000, let's talk about that one first. Anytime you are withdrawing, depositing, or transporting cash of $10,000 or more, they keep track of it. Who are they? Financial institutions, banks, things of that nature. They keep track of cash transactions exceeding $10,000, whether you withdraw. Doesn't mean you did anything wrong, but if something comes up later in your name with money laundering, terrorism, counterfeit money, mob money, they already have a list of each time that you cash of $10,000 or more. That's one thing. The other thing is, when are we as MLOs supposed to report suspicious activity? If we're doing a deal with someone and we believe something is suspicious and it exceeds $5,000, guess what? We're supposed to tell on them. We're supposed to drop a dime. We're supposed to call and say, hey, I think Harry over here got something going on. You guys might want to check him out. That's what you're supposed to do. I don't. I think snitches get stitches, and I'm not telling nothing on anybody. I'm going to mind my own business. But that's not the question. The question is, at what point, my house is not going to be blowing up because I've been told on somebody. I'm going to mind my own business. But that wasn't the question. It says, when must an MLO report suspicious activities? If you think, he don't have no job, she don't have no job, and they just walked in here with $80,000 cash, I think I'm gonna report them. That's what's supposed to happen. All right, here's our quiz. Which regulation requires credit reporting agencies to verify information that's being disputed? That would be FACRA. FACRA mandates that a credit reporting bureau remove unpaid tax liens when? If they're unpaid, they stay forever. Okay, guys, we have spent all that time on federal. 75% of the people that fail the test, they fail it on federal stuff. So that's why I take my time when I go through federal. The rest of the stuff is not that bad, okay, until we get to the math. The rest of the stuff is not that bad. That the SAFE Act defines a non-traditional mortgage as anything that's not a 30-year fix. So they're going to ask you, what is the definition of a non-traditional mortgage? Anything that's not a 30-year fix. According to what law? The SAFE Act. So what is a traditional mortgage? A 30-year fix. It doesn't mean good or bad. You just have two boxes. One box has traditional mortgage in it. There's only one thing in it, a 30-year fix. The other box, the non-traditional box, has everything else in the world, interest only, reverse, VA, everything. According to what law? The SAFE Act. Conforming loans means it conforms to, it meets the standards of Fannie and Freddie. So it conforms to the guidelines of Fannie and Freddie. It can be sold on the secondary market. Secondary market is where lenders sell loans to one another. Primary market is where we as people go to a bank or credit union or wherever to get loans. Secondary market is where lenders sell loans, existing loans, to one another. So if a loan conforms to the guidelines of Fannie and Freddie, it can be sold on the secondary market. Non-conforming loans do not conform to the standards of Fannie and Freddie, so they cannot be sold on the secondary market. They're usually called jumbo loans. That's why they're non-conforming. They don't meet the guidelines of Fannie and Freddie because they're beyond the standard guidelines. Conforming loans meet the guidelines of Fannie and Freddie, and they can be sold on the secondary market. Non-conforming loans do not meet the guidelines of Fannie and Freddie, so they cannot be sold on a secondary market. They're usually called jumbo loans. Another name for non-conforming loan is jumbo loan. The different types of promissory notes that you need to know about, you need to know that an interest-only loan is also called a straight note. Don't get it wrong on the test because they didn't say the words interest only. They said straight note. That's the same thing as an interest-only loan. Partially amortized, you need to know that that's the same thing as a balloon payment. Amortized means paying over time. So a partially amortized loan doesn't go the whole 30 years. It goes usually about 15 years, and then it has a big balloon payment. So you either refinance out of it or something of that nature. But what you need to know for the exam is, what's another name for partially amortized? Balloon payment. Negative am means you made a payment every month, but the balance still grew because the amount you paid didn't cover all the interest, so they added it to the back. And fully amortized, you need to know that another name for that is self-liquidating loan. Fully amortized, another name for that is self-liquidating loan. That means it pays itself off. So if you have a 30-year fully amortized loan, after 30 years, it's completely paid off. You need to know the difference between acceleration clause and alienation clause. The difference between acceleration and alienation. Acceleration clause gives the lender the right to declare the entire balance due immediately. We want all the money now. Why? Because the borrower is in default. If they want all the money because the borrower is late, it's acceleration clause. If they want all the money for any other reason, it's some other clause. Acceleration clause means they want all the money now. Why? Because the borrower is late. Alienation clause, which is also called a due on sale clause, transfer of ownership. So you sold it, you quit claimed it, you deeded it, whatever you did, you transferred the ownership. That's alienation. You need to know how an adjustable rate mortgage is made. The index plus the margin equals the rate. The index plus the margin equals the rate. They're going to ask you, what are the three components of an adjustable rate mortgage? Well, there's an index, there's a margin. When you add them together, that determines the rate. They're going to ask you, what part makes it go up and down? The index makes it go up and down. Sample of indices is like coffee, cozy, LIBOR, prime. You don't need to know those for the exam. You just need to know what part makes it go up and down, the index. What part stays the same for the life of the loan? The margin. How does the bank make their money? Off the margin. But the index plus the margin determines the rate. For adjustable rate mortgages, I want you guys to really take some time to look at the 30-minute video that I made on adjustable rate mortgages on YouTube. Write that down, give yourself a note, go to the YouTube channel, mlotrainingacademy.com/YouTube. Watch the entire, I think it's 25 to 30-minute video all on adjustable rate mortgages. A buy down. Another name for a buy down is discount points. Another name for buy down is discount points. Money paid up front to get a lower rate. Money paid up front to buy down the rate, to discount the rate. How much can I pay to get it down to 4.5? Money paid up front to get a lower rate. You need to know that points are based on the loan amount. Based on the loan amount, not the sales amount, not the appraised amount. Points are based on the loan amount. You need to know in a reverse mortgage, the borrower has to be at least 62. You need to know in a reverse mortgage, the balance of the loan rises, the equity shrinks. The balance of the loan rises, the equity shrinks. And you need to know that FHA's name for their reverse mortgage is called a HECM. FHA's name for their reverse mortgage is called a HECM. When is a reverse mortgage over? Generally, if the borrower passes away, then the reverse mortgage goes away. If they sell the home, the reverse mortgage goes away. If they don't pay their taxes and insurance, they can take the reverse mortgage away. Or if they found out that the borrower has not lived there for 12 consecutive months, they're going to take it away. You have some seniors that commit fraud, and what they do, get a reverse mortgage where they're getting a monthly check instead of making a monthly payment, and they go stay with a family member or friend, and they rent the house out. So they're getting the money from the reverse mortgage to live there, but they're actually renting the house out. But also, if they find out that they haven't been there for 12 consecutive months, they're going to take the reverse mortgage away, and they won't be eligible for another one. You need to know what a hybrid arm is. It's just like a hybrid car. It's just like a hybrid car. You know, a hybrid car is gas and electric, gas and electric. Well, a hybrid arm, adjustable rate mortgage, has a fixed part and adjustable part. See how I have there 3-1? That means it's fixed for 3 years. Then it adjusts every year after. 5-1, fixed for 5 years. Then it adjusts every year thereafter. That's what a hybrid arm is. It has both components. Bi-weekly mortgage, they're going to ask you how many payments would a borrower make in a bi-weekly mortgage plan? 26, every other week. Blanket mortgage covers more than one parcel of land. Covers more than one parcel of land. Sometimes builders go out and they buy a whole bunch of land. Well, land is divided at the county assessor's office in parcels. Well, they don't want to get a loan for each and every small parcel, so they'll get what's called a blanket mortgage. A blanket mortgage covers more than one parcel of land. They may build a house one at a time, but it's a blanket mortgage. Bridge mortgage bridges the gap from one loan to another. A bridge mortgage bridges the gap from one loan to another. Maybe you're selling your house and buying a new one. So you got two things going on. The house you're trying to buy is ready to close. but the house you're selling is hung up in escrow. But you need the money so that you can have the down payment for the house you're trying to get. But the house you're trying to get saying, if we can't close, then the deal is going to be dead. Well, you can go to some banks and get what's called a bridge mortgage just for the amount you need. Sometimes they call them a swing mortgage. Write that down. It's just to bridge the gap from one loan to another. A bridge mortgage or a swing loan. A cash out refinance must have a net tangible benefit. What does that mean? It has to make sense. You had loan originators that were refinancing people. Hey, we can save you $100 for charging $6,000 in closing costs. And then they would go back to them and say, hey, we can save you another $50, but it would cost them another $6,000 in closing costs. A cash out mortgage, a refinance must make sense. It has to have what's called a net tangible benefit. Bridge mortgage, to bridge the gap. How much is it going to take to swing it? Another name for a bridge mortgage is swing loan. For home equity loans and home equity line of credit, you have to know the difference between an open end and closed end. Open end and closed end. Closed end means you borrow the money and you get it from the equity in your house and you're just paying it off. Open end is like a HELOC. It's like a line of credit. You get approved for a certain amount, you can use it, pay it down, go back, use it, pay it down. So a HELOC is an open end loan, but a home equity loan, like a second mortgage, is a closed loan. Package mortgage includes personal property. Includes personal property. Sometimes you can go out to these particular properties, especially the new ones where they're building homes, and they'll have one home that's already completely built, and it's a model home, it's already decorated and furnished and everything. And people will walk in there and they'll say, oh my God, look at this refrigerator. And the agent will say, we can get that for you. Look at the dishwasher. We can get that for you. That stuff is not free. They're packaging the cost of that stuff onto the top of the loan. When they add personal property into the loan, that's called a package mortgage. Here's our quiz. A promissory note calling for only for payments of both principal and interest. What would that be? Very good. What's the clause that gives the lender the right to transfer ownership of the property? That's B. Let's talk about mortgage loan origination. You need to know the process and who does what, the process. It starts with origination. That's you. You or will be an MLO, mortgage loan originator. I call us glorified paper collectors. We start the process. We initiate it. We get the information. We don't approve anything. We just get the information. Then it goes to processing. Once it goes to processing, the processor doesn't approve it either. They are just verifying the information. Once that's done, it goes to the underwriter. The underwriter works for the bank. That's who actually makes the decision. And if it's approved, then it goes to servicing. That's just collecting the payments. That's the process: originating, processing, underwriting, and if it's approved, it goes to servicing. If it's not approved, it just simply gets denied. You need to know that a URLA, what that stands for, URLA, Uniform Residential Loan Application. We generally call it the 1003. Fannie Mae's application is the one that's called a 1003. Freddie Mac's application is called Form 65. You need to know who Fannie uses, 1003, and who Freddie uses, Form 65. There's two types of underwriting. Automated underwriting done by a computer, they call them AUS systems, and manual underwriting just done with a person with a calculator, the old-fashioned way. You need to know that Fannie Mae's automated underwriting system is called DU, Desktop Underwriter. Freddie Mac's system is called LP, Loan Prospector. You need to know that conventional loans are loans that are not insured or guaranteed by any government entity. When we say insured, we mean FHA. When we say guaranteed, we mean VA or USDA. But conventional loans are not insured or guaranteed by any government entity. They actually are made by banks and institutions. The ratios for the purposes of the exam, 28/36. PMI is required if the borrower puts less than 20% down. The late fee is 5% of the P&I only. The late fee is 5% of the P&I only. So let me tell you what I said, and let me tell you what I didn't say. I didn't say the late fee is 5% of the payment. Because what if the payment included PITI? It wouldn't be 5% of that, because they can't charge late fees on taxes and insurance. The late fee is 5% of the P&I only. Do you guys understand that? FHA insures. FHA insures. FHA says, give this person this loan. If they default, the lender is insured a certain amount. The down payment for FHA loan is 3.5% with a score of 580. The late fee is 3.5% with a score of 580. The most that the seller can contribute on an FHA loan is 6%. They may call it seller closing costs, or they may call it seller concessions, or they may say how much can the seller contribute. You need to know it all those ways. Seller closing costs, how much can the seller contribute, seller concessions. On an FHA loan, the max is 6%. The occupancy requirement for a FHA loan, the borrower has to move in within the first 60 days. That's what they're certifying that they plan to do. Who knows what they actually really do, but they're going to sign a certification that they plan to move in within the first 60 days and stay a year. FHA loans do not have PMI, they have MIP, mortgage insurance premium. Well, isn't that the same thing? It is, but for the exam, you need to know FHA loan has MIP, and it also has UFMIP. You don't need to know how to calculate it, the rate, anything like that. Just keep it simple. What kind of loans have PMI? Conventional. What kind of loans have MIP? FHA. And FHA also has a one-time upfront UFMIP premium. There's no prepayment penalty. The late fee is 4% of the P&I. And the ratios for FHA is 31/43. Guaranteed loans. That's a term that used with VA loans. They're saying, give this girl or this guy this house with no money down, Bank of America, Chase, Wells Fargo. Don't worry, if they go into foreclosure, we guarantee you X amount. The max guarantee is 25%. The max guarantee is 25% of the purchase price or the appraised value. There's 2 documents that are needed for VA eligibility. One is called a DD-214 if they've been discharged. It's their discharge paperwork. And the other is called a COE, Certificate of Eligibility, to tell how much they're eligible about. VA only cares about the back-end ratio. It can't be higher than 41%. There's 2 names for VA appraisal: CRV, Certificate of Reasonable Value, and NOV, Notice of Value. VA loans have no down payment, no prepayment penalty. They don't have PMI or MIP. Instead, they have what's called a variable funding fee. Variable funding fee. You need to know who that fee is waived for. It's waived for disabled vets and surviving spouses. Is waived for disabled vets and surviving spouses. The occupancy requirement for VA loan, they must move in within the first 60 days and stay a year. That's what they're certifying. And on a VA loan, the lender, the max that the lender can charge is 1%. And the late fee is 4% of the P&I. 4% of the P&I. So again, there's 2 documents needed for VA eligibility, a DD-214 and a COE, Certificate of Eligibility. For VA loan, they don't care about the front end ratio, only the back. It can't be higher than 41%. A CRV is a Certificate of Reasonable Value. An NOV is a Notice of Value. They do not pay MIP or MIP, but instead, what do they pay? They pay a variable funding fee. The most that the lender can charge for their cost is 1%. The late fee is 4% of the P&I. For a USDA loan, another name for it is a Section 502 loan. Those are loans made for properties that are in small town, farm town, rural areas. The money comes from the Department of Agriculture to build up these areas, and there's no maximum loan amount and no prepayment penalty, and the late fee is 4% of the P&I. Couple of things. The minimum down payment, you guys write these down. The minimum down payment for a conventional loan can be as little as 3% if it's a first-time home buyer, but it's generally 5%. The minimum down payment for a conventional can be as little as 3% for a first-time home buyer. There's programs out there, but it's generally 5%. FHA, 3.5%. For VA and USDA, there is no down payment. As far as seller concessions, write this down. The max seller concessions on a conventional loan is 3%. On an FHA loan is 6%. And on a VA loan is 4%. I'm going to type that in the chat. 3% conventional, 4% VA, 6% FHA. As far as appraisals, there's 3 approaches that you need to be familiar with: the sales approach, the cost approach, and the income approach. The sales approach is the everyday approach, the normal one that we use on a daily basis. There must be at least 3 comps. The cost approach is for special purpose property, vacant land, new construction, or if you're replacing something that was maybe damaged in a storm or a disaster or hurricane. And income is if it's income property. Here's our quiz. What type of loan requires a one-time variable funding fee? Very good. Which is the best appraisal approach if it's new construction? Very good. The reason why I'm saying that is that the max math questions you can get on the test is 7. That's the max that they can give you. And I've been doing this over 10 years, and I've only had 4 or 5 people that ever told me that they got 7. Usually you get 3 to 4, sometimes you get 5. So even if you failed all the math, you can still pass the test. But you just want to make sure. I showed you guys some of the people on Facebook. That girl that got 99%, you guys see we had a person got 99% on the exam. She had 2. Most of the others that got the 90s, the most that they had was 4. We had 63 people so far that scored 90% or above. And most of them, over 30 of them, have been since January of this year. So you guys are in good hands. You just want to follow the guidelines. And like I said, if you do have Facebook, get into the Facebook study group. If you don't, make sure you're following the YouTube videos, things of that nature. A lot of good information. It's a system. And if you follow it, you'll do great. Don't be the Lone Ranger out there trying to do your own thing. We've already done this for you. Just follow the system. And I promise you, you will do great. So here's some tips that you need to know in getting into the math. These are things that they assume you already know. So write them down. Number 1, understand the difference between being paid bi-weekly and bi-monthly. Those are 2 different things. Bi-weekly, there's 26 pay periods in a year. Bi-monthly, there's 24. Like maybe the 1st and the 16th, the 5th and the 20th. Read the problem. Did it say bi-weekly or bi-monthly? If you don't understand that, it's going to be wrong. Number 2, you need to make sure that you use the gross monthly income when doing the calculations. And people want to argue with me with that because you don't take the gross home. I'm not going to argue. I'm just going to tell you what you're supposed to do. To pass this exam, you have to do the calculation based on the gross monthly income. They're going to give you the gross, the net, the hourly, the week. Which one do you use to do the math? You have to use the gross monthly income for all the math. That's tip number 2. Tip number 3 is whenever they give you the sales price and the appraised value, which one do you think you use? Whenever they give you the sales price and the appraised value, which one do you think you use? The lower of the 2. They expect that you know that. The lower of the 2. And always know that they're going to give you way more information than you need. You guys are going to get 15 practice exams from me. Each of them have about 100 questions. You're going to have to know how to decipher those questions. And in the math problems, you'll notice that they give you way more information than you need. Answer what they're asking. Again, use the gross monthly income for the calculations, regardless to pass this exam. So you have to think differently than what you may be doing out on these jobs that you're on now. For the exam, you use the gross monthly income, regardless, taxable, non-taxable, the gross monthly income. If a borrower is self-employed, they're going to want to see that they have 2 years self-employed income on their tax returns. If they don't, they're not going to be able to use that income, self-employed income on their tax return. If they're not self-employed and they're a wage earner, they're going to want to see if they've been in the same field for 2 years. I didn't say on the same job, but the same line of work. If they switch line of works, they're going to want to see some type of certificate, schooling, something of that nature to show why they changed. Alimony and child support do not need to be listed as sources of income if the borrower doesn't want to use them. Listen to me. They're going to ask you, what type of income does the borrower not have to list if they don't want to? You can't force them to use their alimony and child support. If they don't want to use their alimony and child support, these are the only types of income that are optional whether or not the borrower wants to use them for qualifying. Now, why would the borrower want to use them or would not? Sometimes the underwriter sees money coming out of the account and they ask, what is this? And they say, well, that's my child support. Well, we need you to give us proof of that. The borrower can say, well, I don't want to be qualified on my child support. They can't make them. But sometimes the underwriter will say things like, you're about $300 short. Do you have any other sources of income? And then the borrower can volunteer, yeah, I get child support or alimony. But it's optional. And you need to know, based on what law is it optional? ECOA. Tax-free income, public assistance income, which we talked about, Social Security, disability, child support, alimony, all of that is grossed up by 25%. Now, this is the part of the class where someone wants to tell me, but I heard it was grossed up by 15, but I heard it was grossed up by 30. If you want to pass this test, tax-free income, Social Security, disability, child support is increased, they call it grossed up by 25%. So if I say I get $1,000 a month child support, they're going to give me credit for $1,250. Rental income is the opposite. It's reduced. So if I say I get $1,000 a month rental income, they're only going to give me credit for $750. Does everybody get that? Again, there's 52 weeks in a year. 52 weeks in a year. Bi-weekly, there's 26 pay period. Bi-monthly, 24. Understand the difference between bi-weekly and bi-monthly, or you're going to be lost. You have to use the gross monthly income. And if I say that you get paid $600 a week, you can't just take 600 times 4 weeks. No, you have to take $600 a week times 52 weeks in a year divided by 12. Do not take shortcuts with the math. Do everything the long way. To calculate loan to value, LTV, loan to value, what you're going to do is take the first loan amount and divide it by whatever is lower, the sales price or the appraised value, and just press equal. The first loan amount divided by the sales price or the appraised value, and just press equal. If it's combined loan to value, it's the first and the second loan amount divided by whatever is lower and press equal. You guys are going to try one. If you have a home that has an appraised value of $120,000, a sales price of $125,000, the loan amount on the first is $90,000 and the loan amount on the second is $10,000. I want you to calculate the LTV and the CLTV, and then we'll see if you're right or wrong. When you guys have done it, put your answers in the chat and we'll see if you're right or wrong. Very good, guys. Most of you guys got it. If not, like I said, write it down now. Calculating ratios. We call it the front end or the top. On the exam, they may refer to it as the HER. Calculate the HER. I was like, who is she, the HER? It stands for housing expense ratio. The top ratio, the front ratio. You're going to take their house note, which is the PITI, and divide it by their gross, and just press equal. The PITI, the house note, divided by the gross, and press equal. For the back end, you're going to take the PITI plus all their debt and divide it by the gross. Please remember, if the debt has 10 payments or less, you don't count it. It's a Discover card with 7 payments left. You don't count it. The only exception to this rule is an auto lease. So did the problem say an auto loan with 5 payments left? You don't count it. But if it said an auto lease with 5 payments left, you have to count it. Leases count whether there's 1 payment or 100 payments. Leases always have to be added into the back end ratio. That's just the rule. Here's your problem. Smith's annual income is $60,000. Their house note is $1,550. Their debt is $450. Calculate the front end and the back end ratio. There you go. If you didn't get it, go ahead and write it down. These are the ratios you're just going to have to memorize. You're going to get them in the information that I'm going to give you, the study guide, but these are the ratios you're just going to have to remember. Summer, you can go ahead and you're going to get this, and you'll see all of these. But also on YouTube, there's an entire video section dedicated to the math. So take a moment to watch those, okay? Again, these are ratios that you're just going to have to memorize. And like I said, I know that there's other ratios out there for conventional FHA, VA, but for the exam, this is the ones you're going to have to memorize. There's going to be some problems that if you don't know these ratios, you wouldn't even be able to do the problem. Like the problem I'm getting ready to show you next. If you didn't know the ratios, you wouldn't be able to do what's called calculating maximum mortgage payment. There's 3 steps. No one wants to do these 3 steps, but I promise you that if you follow these 3 steps, you will always get the right answer. Step 1 says take the gross times the front ratio and press equal. So you have to read the problem. Is it FHA or is it conventional, and what's the front ratio? Step number 2 says take the gross times the back ratio and then subtract the debt in that order. Step number 3 says which answer is lowest. That's the answer to the problem. Step 1, the gross times the front ratio. Step 2, the gross times the back minus the debt. Step 3, which one is the lowest? That's the answer to the problem. Here's your problem. A borrower has a stable monthly income of $4,000. Their debt is $600. He's getting an FHA loan. So if you have not memorized the ratios for FHA, you wouldn't be able to do this problem. What is the maximum mortgage payment that he qualified for? Go ahead and do step 1, 2, and 3, and we'll see if you guys got it right. Step 1, step 2, step 3. That's what you should have gotten. Okay, so ethics. Ethics. Ethics is all about right or wrong, things you should have learned in kindergarten, tell the truth, be fair, be honest, things of that nature. Ethics deals with fraud. You need to know that actual fraud means they did it on purpose. You knew the check stubs were made up. You was over there helping them figure it out. It was actual fraud. Constructive fraud, it was unintentional. It was due to carelessness or neglect. You didn't know. You didn't know. They're going to give you some scenarios, and you're going to have to determine whether you thought it was actual or constructive. But you also need to know the two types of mortgage fraud. There's fraud for property, and who commits that? Borrowers. Fraud for property meaning they're committing this type of fraud so that they can qualify for the house, lying on their application, falsifying tax returns, making up documents, things of that nature. Why are they taking this risk? Because they want the property. They're going to do whatever they can do to qualify for the property. Fraud for profit, however, can be committed by anyone. This is just people trying to make extra money. People that will, for a fee, they'll verify your employment. For a fee, they'll give you a profit and loss statement. For a free, they'll give you some tax returns, things of that nature. That's fraud for profit. You need to know about these schemes, the air loan. They made the whole thing up. There used to be a time where they would make up an address and they would get it to their friend that's an appraiser. Put this address on one of your appraisals. And anyone, we don't care which one, and give it to me. I'm going to get it to my buddy that works at the mortgage company. And they would get it to the mortgage guy, and they would get paid a commission on a loan that didn't even exist. By the time the bank figured it out, they had to just claim it on their insurance. It was completely made up out of the air. Deed scam, forging someone's signature on a deed and taking money out on their house. People would do that, get their deed and take money out on people's homes. A lot of kids did this to their elderly parents, take money out of their home without them even knowing it. Double sold loans. You had lenders that was selling loans on the secondary market to two different lenders on the secondary market. One didn't know it was already bought by the other. Whoever filed it first got paid. The other one had to claim it as an insurance loss. Unrecorded or silent second. Whenever someone has a lien against your house, it's supposed to be recorded at the county recorder's office. They're supposed to be recording it. Keeping a silent second or not recording it, that's unethical. Equity skimming, making loans to people when you know they can't pay. A lot of loan officers did that because the borrower had a good credit score and they stated their income so that they can qualify for a loan, but they knew that they couldn't afford it. He worked at McDonald's. He made $10 an hour. He had an 800 credit score. You called him a sanitation engineer making $25 an hour. You got it approved. But you knew he didn't make that amount and you knew he couldn't afford it. But you wanted the commission. Equity skimming. It's all predatory lending. All different forms of predatory lending. Loan flipping, refinancing them over and over again when it doesn't even really benefit them. You're just taking the equity out of their house and you're just charging fees and you're just saving them $100, but the closing costs are $6. It doesn't make sense. Straw buyer, using someone else's name to get the loan. Like if I got the loan in my sister's name, because she has better credit. So we use her name to buy my house. I make the payments every month, but I make them under her name. She would be a straw buyer. Bait and switch, an alluring but insincere offer to sell a product or service. You just tell them whatever you need to tell them to get them in the door. You guys probably have been bait and switch before. They tell you any and everything to get you in the door. But then once you get there, then they say, well, this is what I really want to show you. Switch after sale, they take a deposit. They took a deposit. And then when you get there to claim the product or service, they don't want to give you what you talked about. They want to give you something else. But they took a deposit. And now they're refusing to give you the product that they took the deposit on. And bona fide offer, you have to make sure that you're actually, whatever you're offering, whether it's a product or service, that you can actually provide it. You see this violated a lot around Thanksgiving. They would say, we'll give Xbox for $40 to the first 100 people. And then people are sleeping all outside so they can be one of the first 100 people. But they only have 20 Xboxes. How are they going to give it to the first 100 people? It wasn't a bona fide offer in the beginning. Here's your quiz. What is this tactic? Luring people in with one promise and then switching it. Exactly, bait and switch. It would only be switch after sell if they took a deposit. Bait and switch after sell are so close, but switch after sell means they took money. They took a deposit. What is this one when someone actively hides information that's known to be false or misleading? Actual fraud. This is the part of the exam on why you don't have to take a separate exam for every single state. It's the UST, Uniform State Content. You take one exam for all states. One exam for all states. Because this information is the same regardless of what state you're in. You need to know that HERA is the law that created the SAFE Act. HERA. And you need to know that the SAFE Act stands for the Secure and Fair Enforcement Act. Secure. And you need to know that the N in NMLS stands for nationwide. You need to know that you have to have this license if you're going to be taking applications or negotiating someone's mortgages. Those are the people that have to have a license. But if all you're doing is clerical and administrative, you're not actually discussing rates and terms, you don't have to be licensed. If all you're doing is timeshares, you don't have to be licensed. If all you want to do is a loan for yourself or a member of your immediate family, like your son or your daughter, you don't have to be licensed. You can just get their power of attorney and do their loans. You don't have to be licensed. Does a processor or underwriter have to be licensed? What do you guys think? Does a processor or underwriter have to be licensed? Your question should be, it depends on who they process or underwrite for. If they process and underwrite for a bank, then no, they're considered registered. My sister works for Chase. She has an NMLS number just like I do. She doesn't have to take the test. She doesn't have to do continuing education. She doesn't have to do the 20-hour class. She is registered to Chase. But I have a friend that has her own processing company. It's called Unique Processing. She's 1099. She has to do all the same things we have to do. Now, attorneys, if they have to work on the client's loan because they're on their case, they don't have to be licensed. But an attorney that says, hey, I'm going to do loans, they have to do the same things we have to do. Again, you have to understand the difference between registered loan originators and licensed. Registered works for a bank. State license, all the rest of us. You have to have never had your license revoked. It used to be a time where if you lost your license in one state, just move to another state. Not anymore. That's why we have this number. It's tied to us regardless of where we go. You cannot have had a felony in the last 7 years, but if that felony deals with a money crime, ever. So you can almost, if you commit money laundering, okay? Well, no, let me put it this way. Say if you committed manslaughter and it was 10 years ago, you might get licensed because it was over 7 years. But if you did money laundering 110 years ago, you're never going to get it. And a credit union is considered a bank. You have to do 20 hours of pre-licensing, but they're going to ask you in that test, of the 20 hours, how many hours had to be federal, how many hours had to be ethics, how many hours had to be non-traditional, and then the other 12 hours the teacher could have spoke about whatever they felt necessary. They're going to ask you the same breakdown for the 8 hours. Notice federal never changes. And they're going to ask you about the successive year rule. That means you can't take the same class every single year. You can go back to the same school, but they should change their curriculum every year. Because if they didn't, then you didn't continue your education. All you did was repeat it. The state regulatory authority, whatever that state regulatory authority is in your state, they have to supervise you. They need to make sure that you are registered with the NMLS, report any of your violations. They can investigate you whenever they want, however often they want. They can have access to your records whenever they want and however often they want. They can deny you, suspend you, revoke you. What they cannot do is send you to prison. That's not who sends you to prison. The district attorney sends you to prison. The only thing that the state regulatory authority can do, the DBO or the real estate, is deny your license, suspend your license, revoke your license. They can fine you, but they don't get to send you to jail. The penalty for violating the SAFE Act is $28,000. If you do not want to have to pay that $28,000, don't do any of the things that I have on the next 2 pages. But you couldn't do them anyway. Can you defraud people? No. Can you practice without a license? No. Can you fail to comply with the rules? No. Can you make false statements? No. Can you beat up the appraiser if he don't give you the value you want? No. Can you take the people's money on Friday that they gave you for deposit, party with it all weekend, and try to put it back in escrow on Monday? No. Those are all violations of the SAFE Act. Now, this is new, transitional authority. So you may get 1 or 2 questions on that. They call it transitional authority, or they're going to call it temporary authority. And there's 2 parts to it. The one part is for people that work at banks. Like I told you, my sister worked at Chase. One part is for people that work at banks and they want to leave those banks and they want to work independently. Well, they're giving them temporary authority to transition, okay? They have, and the part that you need to make sure you know of is 120 days. Your answer for this is going to be 120 days. What that means is they want to leave the bank, they can operate for 120 days while they do their pre-licensing, while they get ready for the test, while they do their background fingerprinting, things of that nature. They're giving them temporary authority to operate for 120 days while they're making their transition. The other part of that is for us. If we want to do loans in another state, we have the same 120 days. Say if I want to do loans in Arizona, Well, Arizona requires 3 additional hours of training. I can apply for Arizona, and I have 120 days that I can be making money and doing business in Arizona while I'm taking that 3 hours training. Let's say Nevada. Nevada has 10 hours of training. Well, if I'm using transitional authority, I can apply, pay the fee, and I have 120 days to get that 10 hours done. You don't have to take a test. You just have to do the education. You have 120 days of temporary authority, also known as transitional authority, to operate while you are making that transition. The test, the part that's most important, 120 days. Here's your quiz. The SAFE Act makes it the responsibility of the states to use the unique identifiers instead of what? Very good. They use it instead of your social security number. Which one of these from 15 years ago would not automatically disqualify a person? Very good. D. I want you to pay attention to these charts that I made you. It tells you what comes when. It's going to be very helpful for you to remember stuff. The other one, this is TILA, ECOA, FACRA. You want to pay attention to all of those so you can know what comes with. This one is probably the most important one. So you guys definitely want to make sure that you pay attention to that.
Adjustable rate mortgages. So we're going to have a discussion on adjustable rate mortgages. This particular part of the presentation is going to give an overview of adjustable rate mortgages. We call them ARMs, A-R-M, and explain how ARMs work. And I'm also going to discuss the issues that borrowers may face when they get an adjustable rate mortgage. An adjustable rate mortgage frees lenders from being locked into fixed interest rates for the entire life of the loan. So if a borrower gets a fixed loan, that's the same rate for the entire loan. But with an adjustable rate mortgage, the rate is going to adjust up or down depending on the index, and it frees the lenders from being locked into a fixed rate for the life of the loan. So there may be times where the payment is higher, there may be times where the payment is lower. In an ARM, the interest rate may adjust according to the promissory note, and it reflects the current cost of money, meaning what's going on in our economy today. ARMs are popular alternative to financing tools, as many help borrowers qualify more easily for a home, or even help them to qualify for a more expensive loan, because usually with an adjustable rate mortgage, the rate starts a little bit lower than with the fixed rate mortgage. Many lenders like ARMs because they can pass the risk fluctuation on to the borrowers instead of absorbing some of that themselves. So that's why lenders prefer like ARMs in certain situations. So what is an adjustable rate mortgage? An adjustable rate mortgage or an adjustable rate loan is sometimes also referred to as a variable rate loan because the rate is variable. It goes up or down. The interest on the loan varies up or down over the terms of the loan, depending on the money market conditions and the agreed upon index. So there are several components to an ARM. One is called the index, and the index is what's going to determine if the rate is going to adjust. The interest rate on the ARM only changes if the chosen index changes. That's the only time the interest rate will change. The borrower's payments may stay the same for a specific amount of time, maybe 1 or 2 years, and depending on the borrower's agreement with the lender, they're going to determine the adjustment rate period when the loan or the payments are going to adjust. There are several components of an ARM. We're going to talk about each of them individually, but just to give you an idea of where we're going with this, The components of the ARM, we have the index that determines whether the rate is going to go up or down. We have the margin that pretty much stays the same for the life of the loan. We have the rate adjustment period. That's the schedule of time that the rate will stay the same before it actually adjusts, go up or down. We have the interest rate cap and floor. When you're getting an adjustable rate mortgage, of course you want to know how high it can go, what's the highest your rate can be, but you definitely also want to know what's the lowest it can go as well, and that's the floor. And you want to know if it has a conversion option. A conversion option means it has an option to convert at some point from an adjustable to a fixed. So these are the main components of an ARM, and we're going to get into discussion with each of them in just a second. So let's talk a little bit about the index and the margin. The index is an economic measurement that's used to make periodic interest adjustments on adjustable rate mortgages. Again, the index is the part that determines whether or not it's going to adjust up or down. Although the lender chooses the index that will be used, the lender has no control over the measurement. The lender can decide what index is going to be tied to the loan, but they have no control of when it goes up or when it goes down at any given time. That's out of their control. The index is often referred to as the cost of money. That's a term that's used to describe the index. How much does the money cost? And because of market forces, the index fluctuates during the term of the loan, causing the borrower's interest rate to either increase or decrease. That's the whole reason why it's called an adjustable rate mortgage. But you need to know what is the basis that it adjusts on. It adjusts based on the index. The fully indexed rate is a combination of the index and the margin. See, the rate is made up of the index plus the margin. When they add those together, that determines what's called the fully indexed rate, and that's the actual interest rate that the borrower will be paying. The plural of index is indices, not indexes. The index is also shown on the loan estimate. They have to give the borrower what the index will be, the loan estimate, and the index also appears on the promissory notes. So make note, two places that you will see the index is going to be specified on the loan estimate, the LE, and it's also going to be specified on the promissory note. The index is not under the control of the lender. I said that just a few minutes ago, but I want to make sure that you understand the index is not under the control of the lender. It's determined by the market conditions, what's going on in our economy. Here are some common indices that you will hear about. CMT, that's called the Constant Maturity Treasury. There's also called COFFI, that's the 11th District of Cost of Funds. LIBOR, the LIBOR Interbank Offering Rate. CODI, Certificate of Deposit Index. And one of the most popular ones that you'll learn about is Prime, the prime rate. You hear that a lot. A lot of the banks actually go by Prime. Those are just the different names of some of the common indices that are out there in the industry. Let's talk a little bit about the margin. Now, the margin is the number that the lender adds to the index to determine the actual rate. A margin is sometimes called a spread. It's actually the profit that the bank makes. The index plus the margin equals the fully indexed rate. You hear me say that over. How is an adjustable rate determined? How do they determine what the rate actually is? It's called the fully indexed rate. The index plus the margin determines what the rate is going to be. The margin can vary between lenders. The margin is a fixed number. It doesn't change during the term of the loan. It's the actual profit that the bank makes. The margin represents the lender's operating costs as well as their profit margin. The margin is also disclosed on the loan estimate. Fully indexed rate, just want to make sure you get that. How is the fully indexed rate determined? By adding the index to the margin to determine the fully indexed rate. The index plus the margin equals the fully indexed rate. We have an index of 4.25 and a margin of 2%. The fully indexed rate is going to be 6.25%. You simply add the index to the margin to determine what the fully indexed rate will be. There are going to be several terms that you need to know in dealing with adjustable rate mortgages. Things like introductory rate, start rate, lifetime cap, periodic cap. We're getting ready to go through that section right now. But I want to start with the introductory rate. The interest rate on an ARM at the closing is called the introductory rate. It's the rate that you're starting at. It will be in effect for a period of time, sometimes 1 month, could be all the way up to 10 months, but it's the rate that you're actually getting starting at. A couple of other names for introductory rate. They may call it the start rate because that's where you're starting, or the initial rate, meaning it's your first rate. So whether it's called the introductory rate, the start rate, or the initial rate, it's the starting point. When the introductory rate is lower than the fully indexed rate, they call this a teaser rate. They used to offer these a lot. Just to get the bar in the door, we're gonna give you a rate of 0.5% or 1% just to get you going. That's not your real rate. It's going to go up, but this is just to get you started, a teaser rate. You won't see that very often anymore, but you need to know what is the definition of a teaser rate. A teaser rate is when the introductory rate is lower than the real rate, lower than the fully indexed rate. It's called a teaser rate. So introductory rates, whether they're teaser rates or not, they're set by the lender. Rate adjustment period. The rate adjustment period is simply the length of time between the time that the rate is going to adjust. However it was set up. Was it set up to adjust every 6 months, every 6 years, every 2 years, every 3 years? Whatever that period is, that period of time, is called the rate adjustment period. Another term is the cap. The cap is how high or how much it can adjust at any particular time. You don't want to get an adjustable rate mortgage that's starting at 4% and then it's going to adjust to 14%. What's the cap? What's the highest it can go? To avoid something called payment shock, adjustable rate mortgages have caps. Interest rate caps. A rate cap is a limitation on the amount that the interest rate can increase or decrease at the scheduled adjustment date. There may be several adjustments and several caps, but again, that's what an interest rate cap is. The whole purpose of interest rate caps is to prevent something called payment shock. Like I said, what if you're starting at 4%, then all of a sudden at the first adjustment, it adjusts to 14%. Imagine what that would do to your payment. Wouldn't that put you in shock? That's why it's called payment shock. And the whole purpose of interest rate caps is to avoid payment shock. They're kind of a protection. Payment shock is a significant increase in the monthly payment on an ARM that may surprise a borrower. They don't want you to have any type of shock or any type of anxiety about that. So you want to know your caps. You want to know your start rate. You want to know the highest it can go. You want to know the lowest it can go. You want to have as much information as possible. Caps regulate how much the interest rate can increase or decrease over a given period of time. And remember, what's the purpose of an interest rate cap? Is to prevent payment shock. What is payment shock? A big, huge, or significant increase in the monthly payment that could surprise the borrower. There are 3 main interest rate caps. The initial cap, how much can it go up at the very first time? The periodic adjustment cap, how much can it go up each time it's scheduled to adjust? And then the lifetime cap, what's the max it can be before it's capped out? Now we're going to go into them in a little bit more detail, and I'm going to show you how to calculate and determine the caps. Lifetime caps, periodic caps, things of that nature. But we start with the initial cap. The initial cap, meaning the first cap, meaning how high it can go, only applies to the first rate adjustment and indicates the percentage points that the rates can increase from the start rate. So if it's the initial cap, it's the very first one, if it has an initial cap. After the initial cap, a loan, an adjustable rate mortgage, can have periodic caps. Now the periodic caps limits the amount that the interest rate can go up or down at each adjustment period. Again, how often is it scheduled to adjust? The periodic cap, or max, is the most it can go up or down at each adjustment period, each adjustment schedule. For example, if the previous period rate was 5% and you have a periodic cap of 2%, what's the highest your rate can go up or down? Well, if you're starting at 5% and you have a periodic cap that can either adjust up or down by 2%, then the lowest your rate can be is 3. If you're starting at 5 and it can go down as much as 2, that means it can go down to the lowest of 3. But what's the highest that it can go? If you're starting at 5, what's the highest it can go from that start rate of 5 if the periodic cap is capped out after it increases by 2%? The highest it can go is 7. That's what a cap is, the most it can go. Now the lifetime cap is the most it can go over the life of the loan, and then it's capped out, it's matched, it's at the ceiling. The periodic cap is each time it's scheduled, but when does it stop? That's called the ceiling. The life cap, that's the most it can go over the life of the loan. So when someone wants to know what's the max my payment can ever be on this adjustable rate mortgage, that means what's the ceiling? What's the cap? The life cap sets the maximum number of percentage points that the rates will increase over the start rate. Remember, you got to start with the start rate over the life of the loan. It's the ceiling. Here's our example. Say you have a start rate of 5.5%. That's your start rate. And a lifetime cap, the most it can ever increase is another 6% over that start rate. That means that the highest that your rate can be on this adjustable rate mortgage is 11.5%. Starting at 5.5, it may adjust every year, every 2 years, every 5 years, however it's set up, but once it adjusts another 6 points from where it started, it's capped out. The most it can be is at 11.5%. Here's our example. You have a start rate of 3% with a lifetime cap of 6%. What's the highest it can ever be? If you're starting at 3 and you're capped out when it can go up at another 6 from where it started, the most that your rate can be on this adjustable rate mortgage is 9%. Sometimes adjustable rate mortgages are shown in 3 numbers here. See in this our example here, 526. So I'm going to explain that to you. What if your adjustable rate mortgage is shown in 3 different numbers? Some ARMs allow for higher rates changes at the first adjustment, and then they apply the periodic cap to future adjustments. They're usually shown in 3 numbers, like here, 526. Well, what does the 5 mean? What does the 2 mean? What does the 6 mean? The biggest thing I need you to remember is all of these numbers are from where it started, from the start rate, from the introductory rate. 5% is the first adjustment. That's where it would adjust the very first time. The first number is the interest rate cap, the most it can go up the very first time it adjusts. The second number is the most it can go up at each scheduled adjustment. Maybe it's scheduled to adjust every 2 years. Well, the most it can go up or down is 2%. Subsequent adjustments. But that last number is the most it can go up from where it started over the life of the loan. Then it has hit the ceiling. Sometimes, and more commonly, you're going to only see this in 2 numbers. Like in our example here, 2/6. Remember, these are caps. When you see it 2 numbers, just 2/6, the first number indicates the maximum amount the interest rates can increase or decrease at each adjustment period, each adjustment session. However, the bottom number, the 6 in this example, is the most it can increase over the life of the loan. Then it's capped out. It can't go up anymore. Imagine you have a start rate of 4%. They may call it an introductory rate, a start rate, initial rate. But whatever it is, it's 4%. And you have a 2-6 cap. That means that the most it can go up or down each adjustment period is 2%. 2% up or 2% down. But the most it can go up over the life of the loan before it's capped out, it can't go up any higher, is 6. So if you have a 4% start rate and it's capped out at 6, the highest your rate will ever be is 10. It's starting at 4, it's capped out when it reaches another 6. 4 plus 6 is 10. But it couldn't go from 4 all the way to 10 at one time because it has caps per each time it adjusts. If it's starting at 4, it can go up from 4 to 6 because the most it can go up the first time is 2. And then say it adjusts again the second time. It's at 6 now. The most it can go up to is 8 because it can only go up by 2 points. And then say it adjusts again. What's the most it can go up? Another 2. So that's 2, 2, and 2. It's gone up 6 times. It's capped out. It's at 10. It can't adjust any higher than that. It's reached its max. It's reached its ceiling. Let's look at that example again. Say you have an ARM, an adjustable rate mortgage, with a start rate of 4% with a 2-6 cap. Remember, the first number is the most it can increase each time it's scheduled to adjust. But the bottom number is the cap, the ceiling. The most it can increase over the life of the loan. Remember, this is from where it's starting from. So you have to know the start rate. The first number, again, is the most it can increase per each adjustment session. It can go up or down, but no more than 2% each time it's scheduled to adjust. So say if we have a start rate of 4%, the most that it can increase is another 6%, and the lowest that it can decrease to is 2%. You're starting with 4. It's scheduled to adjust. If the most it can go up is 2%, 4 plus 2 is 6. But what if you're starting at 4? What's the max it can go down? 4 minus 2 is 2. However, the most it can increase over the life of the loan, the lifetime cap, we go by the bottom number, 6. What's the highest your rate can be? If you have a start rate of 4 and it can increase a max of 6, that bottom number, 4 plus 6 is 10. The highest the rate will be is 10.
Although rate caps generally protect the borrower, a rate floor sometimes is included in the lending agreement to protect the lender. So a rate floor protects the lender because the rate floor is the lowest that the interest rate can go. The rate floor is the lowest interest rate in which an ARM can adjust. For loans that are sold to Fannie and Freddie, it's usually the same as the margin, meaning it can't go any lower than what the margin is. That way, they're making at least some type of profit.
Let's look at the different types of ARMs. There's the interest-only ARM, payment option ARM, convertible ARM, and hybrid ARM. On an interest-only ARM, it's just an interest-only adjustable rate mortgage. It's where you're only paying a part of the interest for a specified number of years. Usually that's somewhere between 3 years and 10 years. But it's where the interest rate is fixed for the first few years, allowing the borrower to have a smaller monthly payment for a period of time. But then after that time, it's going to adjust. After that, monthly payments will increase even if the interest rate stays the same, because the borrower must start repaying some of the principal and interest. So an interest-only ARM is just like an interest-only mortgage. In the beginning, you're only paying interest. But at some point, whatever is specified, whether it's interest only for 3 years or 5 years or 10 years, after that particular period of time, the borrower will have to start paying on both the principal and the interest. Now, another type of ARM, not as popular anymore, but it was, one of the things that led to the whole subprime mortgage meltdown are option ARMs, or they're called payment option ARMs. They don't do them a whole lot anymore, but you still need to understand it. An option ARM is a type of loan where the borrower can choose from several payments each month. It gives the borrower the flexibility to choose a different payment amount that suits their current financial situation each month. There's usually 4 options. Option arms offer a variety of payment options. They will have a minimum payment, but that minimum payment is less than the full payment, so it normally leads to negative amortization. Or if they're having a good month and have a lot of money that month, they might want to make a 15-year payment, or a 30-year payment, or an interest-only payment. They have options. They can choose the minimum payment, which is less than the normal payment, but the part that they don't pay gets added to the end of the loan, causing negative amortization. They can make a 15-year payment, they can make a 30-year payment, or they can make an interest-only payment. Every month, they can choose a different option. Again, pretty dangerous, because what led to the mortgage meltdown is people paid only the minimum and the balance on their loan grew, and they had a lot of negative am. And the loans did something what's called recasting. Recasting is when they look at it all over again, and then they recast or readjust the loan. Option arm payments were typically adjusted every 5 years. And if they've added too much to the end of the loan, they had too much negative amortization, then that option goes away. Lenders do this by amortizing the higher principal balance created by the negative am. The automatic payment adjusts, and that particular process is called recasting. It amortizes the loan so that it can be paid in full by the end of the term, because if you have a 30-year loan, regardless of how you made those payments, it still has to be paid in 30 years. So they'll recast it, or they'll adjust it based on the options that the borrower made, and see if the payment needs to go up or down, if the payment amount needs to be recast. Now, convertible arm. Some adjustable rate mortgages have what's called a conversion option. That means it's a convertible arm, giving them the opportunity at some point to convert it from an adjustable rate mortgage to a fixed, if it has a clause in it, a conversion clause written into the adjustable rate mortgage. Because normally, to change from an adjustable rate mortgage to a fixed mortgage, a borrower would have to refinance. But if you get an adjustable rate mortgage that has a conversion option in it, you can do that without going through the refinance process. That's already a clause that's built into your promissory note. You want to look to see, and most borrowers want to see if they have an out clause, a conversion clause, so that they can get out of the adjustable rate mortgage without going through the hassle of refinancing the loan all over again. The lender may charge a one-time fee, but it's much better than refinancing all over again with closing costs and things of that nature. When the loan converts, normally converts to whatever the current prevailing rate is. And hybrid arm, it's just like a hybrid car. It has a gas component and it may have an electric component. A hybrid arm is the same way. It's both fixed and adjustable. A hybrid combines the features of a fixed loan with those of an adjustable rate mortgage. A hybrid arm may be desirable for borrowers who plan to sell their home off or pay their loan off in a few years, because it starts with a lower payment normally, which is the adjustable, but then it's going to convert to fixed. The fixed feature gives the borrower some security with a fixed payment in the initial terms of the loan. The adjustable rate feature and the initial interest rate on these loans are typically lower than what's on the normal fixed rate. And you'll see things, they're usually fixed for 3 years, 5 years. I've seen them all the way up to 10 years. This is how it'll look, a hybrid. It'll say 3-1 or 5-1 or 7-1. The 3-1 meaning it's fixed for the first 3 years, then it's going to adjust every year thereafter. Or if it's a 5-1, maybe it's fixed for the first 5 years, and it's going to adjust every year thereafter. The first number tells how long it's fixed for, and the other tells the rest of the period. You've even seen them like these, a 228 or a 327. It's fixed for the first 2 years, but then it's going to adjust for the other 28, and so on and so forth. This type of arm, the first number shows how long the fixed period is for, and the second number shows the number of years the rate is scheduled to adjust. Before the interest rate on the loan begins to adjust, the borrower can decide whether they want to sell the property or maybe they want to refinance the property. So let's take a look at this scenario. Joe and Maria Sullivan are borrowing $280,000 toward the purchase of a new home. The loan is a 3-1 ARM, meaning it's fixed for 3 years and then it adjusts every year thereafter. So the loan is a 3-1 ARM with a start rate of 5.625%, a periodic rate cap of 2%, so the most it can increase periodically is 2%, thereafter a lifetime cap of 6%, so the most it can increase from where it started is 6%. They want to know the highest rate that they could be charged in the 5th year of the mortgage. The highest rate that they can be charged in the 5th year of the mortgage. So let's analyze this. It's a 3-1 ARM, so it's fixed for 3 years. Then it adjusts every year thereafter. The highest that they would be able to be charged is 9.625%. Remember, it has a start rate of 6.25%. It will increase each year after the first 3 years, and they want to know for the 5th years. So that means it's going to increase at least 2 times. The first adjustment, the most it can increase, is 2%. So that means in year 4, which is when they can have the first adjustment, it can go up no higher than 2%. And then in year 5, which is what they wanted to know, how much it would be in the 5th year, it can go up a max of another 2%, which means they would be at 9.625%. Their interest rate can increase in the 5th year is 9.625%.